Labas rytas, labas rytas, labas rytas. Good morning. Good morning, dear ladies and gentlemen, Minister, dear guests, those watching us online. It is my great pleasure to welcome you to what could have been the most romantic financial conference you have ever been to, but gladly we have got electricity back, and we hope that we have it back for good. We do apologize for technical inconveniences. I just want to say that it's not the issue of this venue or this event. The whole street hasn't had electricity for a while, and we really hope that it is back for good now. We're doing everything in our capacity for the event to be as smooth as we can, so thank you so much for your patience as well. To celebrate the magic of power generators and to celebrate the start of this event, I just want to emphasize that I want to welcome you to the 9th International Financial Markets Conference, which is entitled Strengthening Recovery, Developing Resilience. This deserves a big round of applause from you. Thank you. Let me remind you that the conference is organized by the Ministry of Finance of the Republic of Lithuania and the Lithuanian Banking Association. My name is Živilė Kropaitė. I will be your moderator for today. We'll have 4 wonderful panels. We'll go as usual. It's just that we will be half an hour late, but let's hope that everything else will be smooth. COVID-19 pandemic, the war in Russia, the war that Russia launched on Ukraine are the 2 factors that in the recent years have caused unrest in various sectors. Due to the need for urgent adaptation, need to adapt to unforeseen circumstances as soon as possible, resilience has become particularly significant, meaning physical, economical, and financial. So these will be the challenges that we will address today. We will exchange ideas related to financial markets and beyond. To start off, to give us an opening speech, let me kindly invite on stage Minister of Finance of the Republic of Lithuania, Ms. Gintarė Skaistė. Let's welcome her warmly.
Dear all, it's really nice to see you today. Woke up in the morning and thought that I am going to the conference, but afterwards energy crisis arose was all of the sudden, and we didn't expect it to meet in such a cozy lights today, but anyway, it's really nice to see you. In the same block where there is no electricity is not only this hotel, but the bank, one of the banks of Lithuania. So maybe it's not only the energy crisis, but the banking sector crisis in some sort. But yes, I think it's really some short problem, and it will be solved during this day, but the recovery and resilience of these sectors mentioned previously is really important. And we are really meeting in challenging times. Previously we talked about COVID pandemic and the influence of COVID to the economy of the world, to the economy of Lithuania. But afterwards, when we were thinking that the COVID is somewhat over, we can live with that, where everything is changed, but we're getting over it. And then the war in Ukraine affected us all, not only as a person, but looking at the impact to the economy, impact to the economy of the region, even for the economy of the world. And the impact goes through different channels. It's coming through energy crisis, energy prices, and not only energy, but at the same time inflation rises, food inflation, and afterwards interest rates rises. And I think it affects through different channels, and how to build our resilience and how to recover from the impact of this sudden changes. It's really the topic that we should discuss, and we have to find the ways to live was a different reality, because previously it was not the case. So today I'm glad to meet you here in Vilnius. Some of you are locals, so you know everything, but for the guests from abroad who's looking through internet, or who is sitting in this hall, I would like to say that you're coming just right on time, because Vilnius is just started to celebrate 700s of the years when the first time Vilnius was mentioned. So it's a best time to visit our capital city. The first mentioning of Vilnius was when Grand Duke of Lithuania Gediminas wrote the letters abroad asking people to come to Lithuania because it's a very nice country, and asking to come here and to create their businesses here. So I'm glad that you came finally. So, and also about this conference. It's a 9th conference already. I think it's really important that we have sequence, that it's a routine already, and we're discussing how to evolve, how to create the capital markets, how to evolve with the green finance, with sustainable finance in our region, because in some sort, Lithuania maybe is not the big market, and sometimes we have different issues than the other countries. So I think to find innovative ways to get finance, to attract investors, to attract those who want funds in the capital markets is really important. So I think today we have important topics to cover. We will talk about SMEs finance and their intentions to go to the capital market. Also, how to attract retail investors as well, because we see that there are accumulated huge funds in the saving accounts, but not invested in the economy. Also, I think we will discuss the sustainable finance, green finance, which is, I think, the topic that is really important in the present moment, because if we want to go through the energy crisis, not today's energy crisis, but overall, we must invest. We must understand that the only way to go out of this crisis is investment into the green transition. Also, I think we will discuss about the digitalization and how it affects the capital market and the evolution of the all processes that could be there. And last but not the least, the Baltic Capital Market Union processes, what was achieved, what is in the plans of Lithuania and other 2 Baltic countries in a pipeline. So thank you all. I think for you it will be interesting. I hope so. I hope that it will be useful, all the discussions and the ideas that we will share today. And taking this opportunity, I also would like to thank the Lithuanian Banking Association for their help in organizing this conference. I think it's a great tradition. And also I would like to thank all the speakers from public and private sectors. Thank you. I think your experience will be useful to all the participants of this conference. So thank you, and have a very interesting, nice day here in Vilnius. Thank you.
Thank you so much, Minister. We are very glad to have received a video greeting by the Lithuanian Prime Minister Ingrida Šimonytė.
Dear delegates, dear guests, we are truly living through extraordinary times. The world has not yet recovered from the pandemic, when Russia's full-scale invasion of Ukraine brought untold suffering to that brave nation and new challenges to the global economy. Turbulence in the energy sector, high inflation, and rising interest rates have affected the capital market and the broader economy. The task of further developing the capital markets has become harder, but also more urgent. Well-developed capital markets can increase economic resilience, improve accessibility of long-term finance for businesses, boost savings, and provide investment for continued economic growth. Lithuania's capital markets, though small, have a high potential that must be exploited. The government of Lithuania attaches great priority to developing Lithuania's capital market, both at a national level and also at the regional level. Recently, my government adopted capital market development guidelines, intended to incentivize further developments of our capital markets, attract new investors, expand the range of available financial instruments, and improve cooperation between institutions by setting up a coordinating council composed of both industry and state institutions. The guidelines give particular attention to regional cooperation between the three Baltic states, aiming to harmonize financial service regulation and create a common regional market. We hope that this will provide greater visibility to our region and earn recognition from foreign investors. Lithuania aims to become a regional leader in the field of sustainable finance and seeks to create an ecosystem that will help mobilize public and private funds for Lithuania's green transformation. This is especially important in today's geopolitical context. What's more, our fintech sector has grown significantly over the few years, and Lithuania has climbed significantly in global fintech rankings. I would also like to mention that the merger of our national development agencies into a single institution is well underway. The consolidated national institution will be capable of pooling more funds and competences in areas important to the Lithuanian economy. Financial literacy is yet another element which we believe will contribute to the development of Lithuania's capital markets by giving local investors a better understanding of financial products and their inherent risks, helping investors to make informed decisions. Finally, Lithuania attaches great importance to the EU Capital Markets Union initiative and strongly supports it. We place special emphasis on initiatives that contribute to increasing SMEs' access to finance, developing local and regional capital markets, promoting financial literacy, and fostering digitalization and the green transition. Let me wish all of you a very productive discussion today.
Thank you so much, Prime Minister. And since we refer to Ukraine so much, and since you like numbers, there is one number that I have to mention. Not sure how much you follow Lithuanian news, but Lithuanians from 8 a.m. to 9 a.m. this morning, in an hour, collected €1 million to buy radars for Ukraine, which will be doubled by IT company Tesonet. So that's 2 million in an hour. That's how cool we are here in Lithuania. And we'll delve into panel discussions now. We'll begin on the war in Ukraine and its impact and challenges for the capital markets, a panel discussion which will be moderated by the European think tank dedicated to financial services, chairman of that think tank, and a specialist partner of Flint Global, a strategic business consultancy based in London, providing advice on international policy and regulatory developments for financial services clients. Mr. David Wright, who will introduce all the panelists. Let us welcome him on stage first, and then we'll hear from him. Thank you.
Well, good morning, everybody, and thank you very much for this kind invitation to come to Vilnius again. to help you with these discussions on capital markets. And let me begin by introducing our panel and asking them all to join me here. First of all, Alfred Kammer, who is the Director of European Affairs at the IMF. Welcome, Alfred. Our distinguished Minister of Finance of the Republic of Lithuania, Ginteris Skaisti. Former Finance Minister and former member of the European Court of Auditors, Rimantas Satsios. And hopefully on the screen and hearing us well would be Florian Denis, who is in the cabinet of Commissioner McGuinness. Yes, we can see you. Thank you for being with us, Florian. Of the cabinet of Commissioner McGuinness, who handles capital market affairs in the European Commission in Brussels. So the subject that we're discussing, subjects that we're discussing here is about the war in Ukraine, the impact and challenges for the capital markets. And we're going to do this in three sections, if I may very briefly say so. First of all, we're going to sort of set the macroeconomic context, what's happened, where the impacts have been. And Alfred Kammer from the IMF will start us off. Then, after about 20 minutes, we're going to look more towards the challenges of the tragedy in Ukraine, for EU capital market integration and structural reforms. And that will take us 25 minutes or so. And then, most importantly, we've got a section for you. We want to hear your questions to this very distinguished panel. And so please prepare those. We want at least 20 minutes of excellent dialogue with this panel. So let's begin straight away. And Alfred will set us off with looking at the sort of global impacts on the economy so far due to this awful war in Ukraine. Alfred. We want to move forward a bit now.
So we have prepared a number of slides. Thank you for the opportunity to speak here in Lithuania. Minister, ladies and gentlemen, it's a real pleasure. And I think we are already showing resilience this morning by looking at a layered response to a blown transformer here around and dealing with the issue. I want to structure my remarks about 3 points. First, message is that Europe's growth will slow sharply in 2023, but our latest forecasts released just last week show also that the continent's economy is proving much more resilient than we feared. Second point I want to make is that while inflation is likely to have peaked, core inflation could prove sticky, requiring both a contractionary monetary policy stance for an extended period and a restrictive fiscal stance in most countries. And the third point I want to make is that since the onset of the war, natural gas prices have been an important factor underpinning the outlook, with the sharp recent decline in prices to the pre-invasion levels contributing to the resilience of GDP. While it partly reflects a combination of temporary factors, it is also testimony to Europe's impressive response to the energy crisis, which should continue going forward. So let me start with the first point. On the global level, annual growth is projected to weaken in 2023 before bouncing back in 2024, with China rebounding already in 2023. We see a broadly similar picture in Europe, which remains particularly affected by the war in Ukraine through trade, financial, and most importantly, commodity channels. At the same time, world and European growth are holding up better than we thought a few months ago. And you see that in our upgrade of the global as well as the European growth forecast. For Europe, the slightly better picture for 23 relative to our October World Economic Outlook projection is the outcome of countervailing forces. On the downside, we see, due to inflation, eroding real incomes and a tighter monetary stance. On the upside, sizable declines in energy prices and reduced risks of the shortages this winter, and more supportive fiscal policies as a result of energy relief measures. But this outlook remains highly uncertain, and we see challenges. And the challenges ahead are underpinned by the sizable output losses we project for Europe over the medium term, around 2% in the euro area and 4% in emerging Europe, which is comparatively more exposed to the shock. You can see that on the right chart. Medium-term losses in the Baltics are estimated to be broadly comparable to the emerging Europe average. Russia stands out with a drop of close to 9% in 2027 GDP relative to the pre-war trend. Now turning to my second point on inflation. I want to highlight the need to continue with monetary tightening to guide inflation back to target and amid persistent pressures. Headline inflation dropped recently in many European countries, largely driven by lower energy prices. However, core inflation components have continued to increase. While the pass-through from past commodity price increases is one factor, it is noticeable that wage pressures have been gradually building up as workers have sought compensation for high inflation in tight labor markets. So even as we project a drop in headline inflation, we have significantly revised up core inflation over the next 2 years. The large import price shocks has led to the highest inflation rates in the Baltics among euro area countries. Our projections imply a convergence to the euro area average over the next 2 years, although both headline and core inflation will likely prove persistent, as you can see in the right chart. With inflation expected to stay above targets even by the end of 2024, and upside risks to inflation remaining, a contraction in our monetary policy stance, likely sustained over an extended period, will be needed to keep inflation expectations anchored and bring inflation decisively down to targets over the medium term. Our message to policymakers is thus, stay the course on monetary policy. And now moving to the third point, gas prices. An important assumption underlying both the output and inflation outlook are natural gas prices. This has been true since the onset of the war. Energy prices are likely to remain persistently above their pre-COVID levels, and this is a key reason for the medium-term output losses we project. In the near term, however, an important factor behind Europe's better-than-expected resilience has been the recent sharp decline in natural gas prices. Gas prices have dropped significantly relative to our October World Economic Outlook projections and are now back to around pre-invasion levels, as you can see on the left chart. In part, this was driven by temporary factors that could reverse, such as the mild weather and lower LNG demand from China. But this decline also partly reflects Europe's swift response to the energy crisis. Thanks to meaningful demand compression and large LNG imports, the European Union is starting 2023 with above-average storage levels and is well prepared for the remaining winter months, as you can see on the right chart. Clearly, to further bolster energy security, more is needed in terms of dealing with supply issues, and we are expecting this to be addressed. The recent decline in energy prices also offers an opportunity to scale down energy relief measures and shift towards more narrowly targeted and non-price distorting ones. This will also support broader fiscal consolidation goals. Fiscal policy should therefore in general be contractionary at the current juncture to support the monetary policy tightening and anchoring inflation expectations. This is certainly true in the Baltics. And I conclude with the following few words on the implications of financial markets and risks. As discussed, we see the need for continued tight monetary policy as inflation could prove stickier than many market participants currently assume. This means that recent easing in financial conditions might not last. Add to this the considerable tightening of bank lending standards in the past year and expectations for further tightening in the coming months. The likely challenging financing environment for European corporates in the period ahead strengthens the case for further developing European capital markets, including by completing the Capital Markets Union. This would not only enhance the macroeconomic risk sharing within the euro area, but also help European firms tap more non-bank private savings and rely less on banks. Thank you.
Thank you very much, Alfred. And it's a slightly improving picture, and certainly the markets yesterday and this morning seem to be becoming more optimistic after the latest round of central bank increases of interest rates. But even so, they've reacted quite positively. Now, Florian, can we see you here? Yes, welcome. The European Union has been extremely active in many different areas as a result of this crisis, and indeed of the COVID crisis before. Give us your take on the macro perspectives and how you see things developing in the European Union.
Thank you very much. Thanks, David. And I just would like also to mention that my commissioner didn't came to Vilnius, and I think the reason is obvious today. She was in Ukraine yesterday with the 15 other commissioners at the European Commission. So apologies for that. She would have liked to come, but I think that everyone understood why she could not come today. I just would like to echo what Alfred said. I think that there is quite a sign of optimism at the moment, but we are facing major challenges, and I will echo those which are mentioned by Alfred. I think we are facing high inflation due to high energy cost, but I would also mention also disruption in the supply chain across the world, which was a big problem also from trade to finance, also to food security. I think that we are facing a lot of challenges. High inflation means also that the interest rates are rising by the major central banks, and I think it's a challenge also for the financial system and for because it's a different environment. So we have good news. The price of gas is lower compared to a previous level in 2022. We have good sign also in the employment market. I think it's important to mention that. But I think that what I might take also on the financial side is that the financial systems prove to be quite resilient at the moment. I think it's good news. If you look at banks, they continue, thanks also to the reforms which were made after the great financial crisis in 2008, they continue to provide loans to companies and to households. So I think that there are also some good signs about the structural reforms that have been made a few years ago.
Thank you. Thank you very much, Florian. I have to agree with what you said. I think in the last few years, if I may say so, the European Union has reacted impressively in many areas. In the reaction to COVID, with the new generation economic programs, we're seeing the developments, not without difficulties, but we're seeing the development of an energy policy at last at the European Union level. This has been quite impressive. And as you say rightly, the financial system so far, touch wood, fingers crossed, has remained resilient. Minister, looked at from your country perspective, what have the main impacts been? Alfred mentioned very high inflation, but how do you see things? Can we be a little bit optimistic?
Looking in today's perspective, I think we can be optimistic, but maybe looking at the perspective that might happen in the past, if the war wasn't there, I think that maybe the consequences for our economy would be much different than we do have now. Looking at the bare numbers, I would say that the economy of Lithuania seems quite resilient, and looking the consequences of COVID-19 and also the war, the economy of Lithuania was affected much less than the other countries of Europe. And even when we predicted, when the war began, we thought that the exports, imports from Lithuania will be affected much more than it was in reality, because previously we thought that the relations with Russia, Belarus, Ukraine, which were quite tight previously, and anyway the war affects the trade relations, that the exports will decrease in 2022, but the result, the outcome, the reality that we see, that the exports and imports increase by 11%. So anyway, the businesses seemed quite creative to find other ways where to export, from where to bring their goods. So I think the economy seems quite resilient. But last year our growth was 2.2% of GDP. And for the next year, we expect to be in a path to growth by 0.7% of GDP, but the result is not so good as it was in 2022. But the reality sometimes seems to be a bit different from the projections. So we'll wait till the end of 2023 to see what's really will be there, because previously, in 2022, when we were creating the amendments to the budget in the middle of the year, just because of the war, of the inflation, of the energy crisis, we predicted that the budget deficit will be minus 4.9 last year, and the outcome we'll see it in the end of March. But now we see that in reality it will be really below minus 2%. So the outcome is quite better. From one side of the revenues of the budget, which seemed better performing than we expected, and from the other side, we use less funds for managing the crisis than we thought. The same, I think, will happen with this year's budget, because we created the budget and again minus 4.9, the predictions. But now we see that the energy prices are falling, so I think we will not use all the funds that were dedicated to the compensation of the electricity prices or gas prices to the households and the businesses as well. So I think that the outcome also might be better. So half of this budget deficit is dedicated just to this managing all this crisis. Refugees from Ukraine also spending to electricity and gas compensations. So the outcome might be better than we expected. But looking at the labor market, we see, as it was mentioned, labor market looks really strong. The employment is in a record levels, and employment rate is in a very low levels, and quite the same is expected for the next year. So I think it's a really good sign for the economy of Lithuania, because labor market is really one of the most important factors that affects not only the economy itself, but the perception of the society, how you're living, and the expectations, how you want to spend your money, how you want to invest, and everything. So I think it's really a good sign. And the same with the wage growth rate. Somebody is thinking that it's a good sign. For others, maybe it's not, because if it's your costs, so maybe the fast growth rate of wages is not so good for you. But in my perception, in this situation, really, wage growth rate is a good sign, and we have seen the same in the last maybe 4 or 5 years in Lithuania already. So in 2022, the wage growth rate was 13%. In next year, we expect above 9. So looking at the inflation rate that we did had in 2022, I hope that the purchasing power of people will be in a better or the same position that was previous the war. And concluding everything what was said about Lithuania, I think that the war also impacted us not only as a country like Lithuania, but also all the Europe, because the energy crisis has the consequences in all the countries of Europe. Maybe not in the same size, the effect, but we have seen that all the countries have to react, and we're showing the packages of support to businesses, to the society, compensating one another, how you fight inflation, and all these sudden packages were influencing other countries to have their own packages. So in my opinion, it is a good lesson showing that we must coordinate more, because without coordination it looks sometimes a bit like a mess, and the consequences of all these support packages maybe in somewhat the effect is not in a most effective ways that we would like to expect. And the support packages, especially for businesses, they are distorting the single market, because one countries have better fiscal capacity to support their businesses, like big countries in the Western European part, but maybe smaller countries like Lithuania are not always at the same capacity level to help to their businesses. So if we wanted to preserve the single market principles and to have fair conditions to all the businesses to compete with each other in fair conditions, I think the coordination of the state aid is really important. And I hear in the current circumstances when the US have their Inflation Reduction Act, and some countries like Germany and France would like to react very fast to have their own additional funds to have the fair consequences, competition level with the United States. I think we should be cautious because really the single market is something that we must work on it, and to destroy it is really easy. So in my opinion, state aid rules, they were created not for nothing. They were created because it is needed. So I think we can build resilience in many ways. Structural reforms are very important. Green transition is important. And Europe always has invested much more than United States into a green transition. So maybe look at the bright side of what was done, what investments are coming from the cohesion policy, from the RRF, Repower EU instruments, and to work with the instruments that we do have now, and maybe not to try to let everybody to do what is on their head, because the coordination, I think, is a key for our recovery and resilience. Thanks.
It's a very interesting point you make there, Minister, because I think you're absolutely right that in the European Union, the single market has been a great success. You can see that today, by the way, when you look at the problems the United Kingdom has by not having access to the single market. The UK is now almost the worst performing economy in the Western world. And you know, I think you're right that we have to be very careful not to sort of get into subsidy races or state aid races, which actually will end up fragmenting and actually distorting market forces. So I think, and I'm sure hope the European Commission and other member states will be very sensitive to that, and also the large member state, small member state point you make. Now, Ramantas, you're a very subtle observer of what's going on in Europe, and a great European. The impacts of this war, I mean, do you see more integration happening in Europe? Are you worried about what's happening? What are your thoughts?
It's a very, very, very interesting aspect of the question. And first, of course, I completely agree with what Minister said just now. And let me illustrate this. And probably, well, the Court of Auditors, which I left very recently, these are people who are trying to face a real reality. I'm sorry for this tautology, real reality. Our findings show that it is always complicated, but in many cases also unpleasant. So we do have unpleasant reality, unpleasant challenges, and the war is one of them. The war is one of them. Now, of course, I have a feeling that in this case we deal with a long-term problem. For the long-term, for short-term problems, we can apply tools, different facilities, things like that, to cope with some consequences that arise or not. But for long-term problems, we should have stable and long-term solutions. So now, just to illustrate the question of priorities. One of the priorities that emerged very recently last year, I think, is integration of Ukraine. So people were talking on the theoretical terms about that before, but on 24th of February, very many people, by the way, across Europe differently, but understood that integration of Ukraine is inevitable. Practical integration means, of course, coping with the corruption. There is findings of the European Court of Auditors that high-level corruption in Ukraine is something terrible, and we see very recent actions of the Ukrainian government. To integrate real people, and I'm happy to tell you that at the Court of Auditors we have 6 very excellent ladies from Ukrainian Supreme Audit Institution working as delegated national experts to acquire expertise, and of course this is the first step. By the way, Court of Auditors was the first European institution to take on board on real positions the people from Ukraine. The other side is much more important. Rebuilding. It will come. Inevitably, it will come, a rebuilding of Ukraine. And the simple fact is that the public sector will not be able to cope with that. And for that, we need private money and private instruments. Now, to priorities. My feeling, and by the way, yesterday we published a report, the Court of Auditors published a report on adaptation of cohesion rules, cohesion policy rules to cope with the COVID infection. At the time we audited COVID infection, the SURE instrument, but also adaptation of cohesion policy rules. One of the important conclusions of this report is that this very free changing of rules may impact the initial strategic objective of the instrument. So now in Europe, I can observe, changing the direction of the tools, depending on emerging priorities. And I think the gradation of priorities and keeping the old priorities in place is absolutely crucial, as Minister just said, for retaining the single market. I'm very unhappy, and the court was criticizing Stability and Growth Pact, in fact, termination of this pact, because the talks about reforms are continuing, and the switching on again the fiscal rules is postponed and postponed. Of course, very clear, very bad signal is this state aid proposal, where probably 70% of this state aid will go to French and German firms, absolutely disproportionately to the size of their economy, and this will impede single market. So priorities, ranging priorities is the first point that is needed to my mind. Second is single market tools. They are needed even more than before. As I said, for rebuilding Ukraine, you will need capital markets. You will need them. because without capital markets, I'm not talking even about green transition, which was discussed in the previous conference. Single market tools is something that we should care about. And this concerns also the member states. It is not only a European problem. So building capital market in this country, in neighboring Baltic countries is very important. And the third, I would insist, we should make full use of European institutions. Because I saw them. They are working very well. They are very smart. These are very devoted people. But sometimes, say, among regulators of financial markets, well, they should rely on national institutions. They should rely on goodwill of the Council. Minister, it was in many cases in European supervisory authority state. So I think we should think, and small countries also can have equal voice with others pushing for better implementation of the functions of the European institutions. So priorities, single market tools, and institutions.
Very interesting comments here, Mantas, and it's clear, isn't it, that the rebuilding of Ukraine, as you say, which is inevitable, is going to be massively expensive. I think all the numbers you hear are astronomical, 500 billion, 1 trillion, who knows. But I think what's important here is that the European institutions start to prepare, because for sure an awful lot of the burden is going to come our way as Europeans. And therefore the capital markets, as you rightly say, are going to have to play a big role. And let's now turn to the capital markets, because you know, are they ready for this challenge and other challenges, Europe getting older and so forth? So let's turn to Florian in Brussels. You're driving this process, Florian, and your colleagues. Where are we with Capital Markets Union? Are we actually making any progress? We haven't got much time left in this European political cycle, because Q1 next year and the machine starts to slow down for the European Parliament elections and so forth. Give us your take on where we are. It seems to me there's an awful lot to do.
Thanks. I think that, I mean, despite, I mean, the challenging conditions, I mean, I would say, and the very, I mean, the big challenges that we are facing at the moment, I think that we have made good progress on the Capital Markets Union in terms of delivering what was in the CMU action plan that we adopted in 2020. And I just would like to give you two examples of what we have proposed. I think that the first one would be all the market infrastructures that we have in Europe. So I would say what is driving, trading, settlement, clearing. We had a proposal on each of these pieces. We had the MiFIR review, we had the CSDR review, we had the EMIR review that we proposed in December. So we are delivering on what was in the CMU action plan. The second thing, I think that we are also acting on structural barriers, because we know that the CMU is a very complex project. I think that there are several dimensions, and there are also some structural problems which hinders the integration of the capital markets. And one of them, for instance, it's the divergence in insolvency law, which was mentioned several times by the IMF, the ECB, the OECD, all those public bodies say that basically it will be a capital markets union will never happen if we don't have a reform in this area. And we propose, the Commissioner Renders and Commissioner McGuinness proposed in December, a proposal of directive in order to make it, I would say, more transparent and to deal with cross-border aspect of insolvency, and also a specific regime for micro enterprises. I think that when we were speaking about the Capital Markets Union in 2015, we were thinking about the structural reform, so we are doing it. Now, I would say the ball is in the camp of the co-legislator also to keep the ambition of what we are proposing, and also I think what is very important is the timeline. I think that we need to have quick, I would say, agreements on what we propose in order to keep the momentum behind the Capital Markets Union. And if you allow me, I just would like to say Capital Markets Union is very relevant in the context, and I was just I was listening carefully to what the minister and what Mr. Zedius was saying, but let me give 3 examples of Capital Markets Union, a good Capital Markets Union, well-integrated Capital Markets Union could do in the present context, if we had it already. The first one is that there is a huge debate on the competitiveness of the EU economy, and on Wednesday we adopted the communication on the Green Deal industrial plan. And I think I cannot agree more. The biggest strength of the EU economy is the single market. And the single market is also the single market for capital. I think that we cannot, I would say, finance the transition to the net zero economy without strong capital markets. And I think we need to have developed capital markets, but above all, integrated capital markets, not fragmented 27 different national capital markets. The second thing is also the current geopolitical context with the war in Ukraine. And I think the cost of energy, we know that we have to reduce our dependence on fossil fuel. So if we want to have financing of, I would say, renewable sources of energy for the European Union, we need to have capital markets. Public financing will not do the trick. We need to have well-functioning capital markets. And the last point is also for people. I think that we have high inflation, and I think that some of us are just putting our money on bank accounts with almost zero interest rates. I think that it's interesting also to see that the impact of inflation on the savings of people. And what we are doing with CMU is to create more investment opportunities for people to invest cross-border, to find right investment opportunities where they are. And I think that it's very also important to make progress on increasing the participation of retail and institutional investors in capital markets and on a cross-border basis.
Thank you very much, Brian, and we wish you every success in delivering all these important projects. I'd make 2 comments and then ask the Minister for her reflections about how capital markets are developing here. First reflection is that if you look at the United States, one of the great strengths of the United States, 2 actually. First is they have a private pension system financed through the 401k mechanism, which is just massive, absolutely massive, provides a huge corpus of capital for the rest of the economy, and we don't have that in Europe. And I think the second thing in the United States, and this was a point the Prime Minister made earlier, is the way that they are able to finance small companies into world-beating companies. And along that process, of course, jobs, innovation, and all the rest comes with it. And we've lost too many companies over the years in Europe who've gone off to the United States to get finance. And I think we need in Europe to really tackle those issues. Minister, I remember last year you were talking about the development of the Baltic capital markets. The Prime Minister has also made a reference to that. How do you see things? Are you making progress?
I think we always are making progress. So without progress, we will just die. And I think, yes. But maybe to start with some small reflection to what was said about the last window of opportunity to have proposals that would make the huge impact to the evolution of capital market. I feel you very very well, because I'm in the middle of the term in the parliament and in the government, but I'm always asked, it's the last window of opportunity to propose reforms, because then you'll have to work on waiting for elections and just being kind to everybody. So you have to impose all the reforms now or never. So I feel you very well and understand your concerns. But talking maybe about the capital market situation and the capital markets in Lithuania, I would stress that there are maybe 3 different levels of work that is going on. One is European level, and there is some movements there that we are quite happy with that. I think one of the biggest priorities for Lithuania is helping to finance SMEs, because it's a biggest pool of Lithuanian businesses. So to create favorable conditions and to have better situation for them to attract the capital is really one of the biggest priorities. So the Listing Act package that was proposed, it's really, I think, will help in the situation. Also, corporate insolvency directive, it's also the good direction to work. But from the different side, I think also we must understand that a lot of funds now is being kept in a deposit deposits instead of being invested. So we are very waiting for a retail investment strategy proposal from the Commission. And I think that it's really important for the countries like Lithuania. It's really important to attract the funds that are now stuck in the deposits. And now we see the numbers of deposits of people in the banks in Lithuania, and we see that numbers are constantly increasing from the COVID period, and they increased quite sharply. So I think all these funds better have to be invested in the economy and not just losing their value in deposit accounts. Also, it's important to have better conditions for institutional investors. And in this regard, the review of alternative investment funds managers directive is expected from the Commission as well. Looking at the regional level, the Baltic Capital Markets Union, we have stressed previously 3 maybe main streamlines where we are working. One of them, it was to unify a regulatory framework for covered bonds, and it was done during this year. Now we have the same regulation in Estonia, Latvia, and Lithuania for covered bonds, and I think it's one step forward. Another streamline was Baltic Capital Markets Development Accelerator Fund. So now we have a situation when Estonia is still thinking if they really want to be there, but with Latvians we're moving in that direction, and I think in this year maybe we will finalize the creation and of the accelerator fund. We have several more initiatives. Maybe to have one of the main new ideas that we would like to cooperate and to have more intense dialogue with Latvia and Estonia is sustainable finance, and we would like to be the regional leader of the green finance in Baltic states. In Lithuania, and now I'm going to the last level, from the Baltic capital market to the Lithuanian daily things that we're doing to increase the capital market level in our country. So the last work that was done, so the proposal on the green finance working plan for the upcoming 3 years, how to make the situation better. So one of the initiatives is to create Green Finance Institute in our development institution, and I think it will be like catalyzer to the changes in the green finance situation, because now we see that the numbers needed to the green transition is really huge, and so just the public funds will not be enough. We will have to invest the private money as well. So to make the good ecosystem for green finance is really important. So our ambition is to help the SMEs, to help businesses to know how to label their product, how to give this information to the investors for them to know that the product is green, and to make the database of the information that is needed, and afterwards maybe even to label some products for investors and to businesses to get to each other and to facilitate the green transition funds. Also, another job that we have done is capital market development guidelines, also for the upcoming 3 years. It was a job that was done together with the Bank of Lithuania, and I think together we will make the situation move a bit faster than it was previously. Also, we created a capital market council, and I think in this council we will share the ideas, share the knowledge about what changes are needed, and maybe to share the better examples, and in this case move forward smoother to the direction that is needed. So a lot of is happening, but anyway, all these changes are not very fast, and maybe the results will be not today, but I expect that the Capital Market Union anyway is helping for us to attract the capital, to invest the capital, and to invest the capital into the directions that is needed to the transformation of Lithuanian economy.
Thank you very much, and I think you're right when you say that these types of measures, and Florian, the ones he was talking about, they do take time. Not only to agree, but they take time to have their impacts. And I think what's important from the market perspective is that people see the direction of travel, and that the direction of travel is a consistent one. It's not veering to the left and to the right. And again, a UK example here, which everybody will be aware of, the short-lived government of Liz Truss darted out a budget which was catastrophic. And international investors immediately put question marks about inconsistent policy. So I do think that point is a very fair one. We've got to watch the clock. Rimantas, what's your take on capital markets? You've already touched on it.
I will touch 3 specific points. The first point, and I think this audience is very fit that I could argue to you and ask you to think about it. The roles of public and private sector in creation and functioning of capital markets. It is absolutely not true that the public sector institutions could buy the capital markets union for the society, for the It is an excellent news about this council in Lithuania, Capital Markets Council. If it is going to be dominated by the public institutions, by the public authorities, probably we will be in trouble a bit. What we really see, ambition was very high. In 2015, the first capital markets plan, ambitions were very high. We audited, the Court of Auditors audited implementation of this capital markets union action plan. Formally, everything was done, but it didn't work because probably stress on wide participation of the markets and real impact of the measures in the market was not assessed. So catalytic effect of public sector measures can be achieved, but it will be only catalytic. Catalyst is a small amount in the chemical reaction. The chemical reaction should have reactants that operate and money flows. Second point is a bit legalistic. As I'm a lawyer, in my second background, in the law, and probably people in the audience could also recall, there is a concept of efficacy of law. In principle, the parliament can adopt any law, whatever it likes. There is not the fact that it will operate. If there are no conditions for the law to operate, the results can be very tricky. Now, we audited a single market of investment funds. Of course, the court found that there is no single market for investment funds. And there is a very good idea, passporting regime for investment funds. They get a passport that they can install wherever they like in the European Union, then can be domiciled from Romania to at that time, UK. But the fact is that almost all funds are domiciled in 5 countries. Why? There can be different reasons. We did not analyze. Of course, these are centers of excellence. It is good to have centers of excellence. Bad thing is that 70% of funds, they are marketed by domestic asset managers. And they don't go cross-border. So real cross-border funds in Europe are very scarce. Legislation looks very nice. Passporting regime, it's okay, really. But the law doesn't work. Different issues like taxation probably is another reason. And the third point, the longer I think, and of course I see the development of capital market in Lithuania during 3 conferences, because we are talking here, but the more I understand that CMU and capital market itself probably, first of all, is a cultural problem. It's a cultural problem of culture. Transparency, it is understanding and trust. Of course, transparency of capital market instruments, of capital market itself, means that you should have some understanding, but you should also trust to something. Understanding is easier to reach with financial education. How to impose this trust, also financial education. I think one of the methods to induce more trust is activities of public development funds, and this is again a catalytic effect of the public institutions. So not a huge amount of money, but we do have resources. We can use this for good. But otherwise, well, IPOs, they are not popular in the Baltics, yeah, because people, well, at best they release bonds. So equity financing is at the very beginning. Why? Cultural reasons, because I don't want to lose my property in my small firm. I would rather find cheaper or less cheaper bank. So even, of course, we have high inflation now, and rates are growing. Yeah, the market rates are growing as well. Is it good or bad? Inflation is bad. But interest rates, positive interest rates, it's returning to new normality. But here again, I recall my experience when there was a discussion about building the new power plant in Lithuania. And we had proposals, we had calculations, and the private investor wanted 8% return on its investment. And we understood that at present conditions it would be very difficult to sell to a political community that should take the final decision. I think the same remains now. So financial literacy, I think not only at schools, it's primitive, not only for small and medium enterprises that was recommended by the Court of Auditors and then included in the Council conclusions, but some financial literacy of elites is also needed. And here I put the stop.
Very interesting points, and I think my personal view is that those countries in Europe that inject or require financial education throughout their education systems, and indeed onwards through working lives, I think that's a very, very smart investment. After all, I mean, when I was young, we learned gymnasium, and we learned Latin and all sorts of things. Were we taught anything about finance? Absolutely nothing. And you pick it up through life, right or wrong, and probably in most cases not very well. I think the case for financial literacy in schools, from the youngest age actually, is really very, very high. Alfred, I remember the IMF when we went through this new cycle of the Capital Markets Union. I remember two things the IMF said. They said, build a central repository of information about listed companies, a single market action point, if you like. And as I recall, it was insolvency, which Florian mentioned. When you look at the capital markets development in Europe today, where are we from your assessment, and what's missing?
We have not made sufficient progress. And clearly, we need to work harder and faster in order to get the capital markets union done. That's the bottom line. We all agree that investment and growth is important, and the capital markets union is critical actually to achieve our goals there. But as the minister made a link to the climate goals, I also want to make a plug why the capital markets union is so important for achieving the climate goal in the European Union. The European Commission has estimated that in order to reach the mitigation emission targets, what we need is investment of between 3 to 4 trillion euros by 2030. That is a truly large number. And they also pointed out that 3/4 of that needs to come from the private sector. As Rimander says, the public sector can be catalytic, but the heavy lifting needs to be done by the private sector. I think an important point to recognize also is that when you look at investment needs, they are largest in the energy-intensive countries and lower-income countries. And again, you need to tap capital across the union in order for these countries to make these investments. Now, you could say that bank lending is the solution in Europe. When you're looking at bank assets, they're 300% of GDP in the European Union, in the euro area. They're 85% in the US. But there is a vast potential of in terms of private savings, which you can tap in the European Union as well. There's a lack of scope right now. When you're looking at enterprises, non-financial enterprises, balance sheets, 1/3 of their liabilities is in stocks and in tradable stocks and bonds. When you look at the US, 2/3 are in tradable stocks and bonds. So there's a lot of scope in order to tap this potential. The second point is European markets are vastly segmented. There's a huge home bias, and we have 27 capital markets. We don't have one capital markets. So there's lots to do. So what are the key obstacles, David? One is the barriers to integration in order to get a level playing field. When we studied this, the average Italian and Greek companies in a given industry pay substantially more on its debt than its peers in Germany and France. That is a function of the domicile. This has nothing to do with the credit risk of these companies. That's something one needs to fix. Integration needs to move. The second point is we have restraints on innovation and growth by firms with few tangible assets to post as collateral. Think about the typical IT firm. And they have a huge problem in assessing bank loans. Now, our research suggests that startups grow much faster in Europe, in those member states, which have venture capital funds and better capital markets. So again, if you want to tap and move on the IT front, on the digitalization, have this vibrant entrepreneurship, you need risk capital be made available, and more can be done there. And the third point is you have weak cross-border risk sharing. In a truly integrated capital markets, households will hold equities of a variety of countries. So whenever there is a domestic shock, their wealth is not affected directly, and that helps to consumption smoothing. And our analysis suggests that this consumption smoothing effect is 4 times stronger in the US and Canada than it's in the euro area. And again, this is a very important point in terms of managing the cycle, the business cycle. So what to do about this? The EU action plan has a long list of to-dos. I want to suggest 3 points to focus on. One is transparency, and Rimantas and David, you already stressed this point. To improve access to firm-level data, we suggested a European database modeled on the US Security and Exchange Commission's one-stop shop for free public access to corporate prospectuses and financial statements. It seems simple to do. We need to move on that. Second, insolvency. Here, the European Commission could develop a code of good standards in corporate insolvency and systematically report on member countries' progress in observing them, very much like the Basel Core Principles process for banks. And finally, and third point, oversight. This will require convergence, where supervision remains natural, and more centralized oversight for larger players. But progress has been slow and uneven. I should say, on a positive note, the European Commission has displayed commendable level of ambition on insolvency reform, pushing not just for good standards, but for harmonization about critical elements through EU legislations. However, the single access point for corporate information has been pushed back to 2026 to 2030. And little or no progress has been made on strengthening oversight cooperation. So we need another policy push. A fully integrated CMU will not only support growth, but also make sure that we see the investment at the scale needed to achieve Europe's climate goals. And last but not least, the CMU will allow capital to flow where it's most critically needed, to energy-intensive countries, faster-growing countries, such as the Baltics. So it's a no-brainer, but we need to really accelerate the move to the capital markets union.
Well, I think we all share those thoughts, Alfred, that we're going in the right direction, but we're not going fast enough. And, you know, when you listen to this debate, you just see so many multiple benefits of deep capital markets right across the European Union. If you think about small companies here in Lithuania, wouldn't it be nice if they had more options to finance, to grow and become world-beating companies? And there's no reason why they shouldn't be located here at all. So let's have some questions from you, and I apologize we've slightly run over time, but we're going to hear your questions. Who would like to we've covered a lot of ground. Who would like to ask some questions to this distinguished panel? No takers at the moment. Anybody? One person here to the left. Thank you.
I work in the banking sector, and we're responsible for the flows of transactions and cash and funds. One of the big, huge problems is the huge burden of regulation for the AML especially. If Europe would look at this more sensibly, I think capital would flow much easier to where it should go, instead of now huge burdens of paperwork for we in the sector don't even know what they're looking for. It's just sort of a work creation program for big bureaucracies. So if anyone can comment on that.
Florian?
No, I mean, it's always a very difficult question, because hearing from the panel, I think that on the one hand we say, we are not advancing very fast on the capital markets union, but we are delivering, and I can tell you that we are delivering. We had all but one legislative proposal under the first CMU action plan, which were adopted by the co-legislators. We have already delivered 11 out of the 16 actions which are in the CMU action plan. I think that the problem is that the regulatory, the intervention of the European Commission is essentially regulatory. We can act on the regulatory side. I think that it's the top-down approach that we can have. I welcome that the minister mentioned the bottom-up approach. When it's come to regulation, it's also important to have convergence. And sometimes it's true that in some of the texts that we have, it can be a bit burdensome for market participants, but it's also important, to have a level playing field and to have convergence across the European Union. And sometimes when the texts are not specified, in guidelines which are provided by the European supervisory authorities, sometimes we have the criticism that it's not clear enough and that there is an unlevel playing field because, there can be some supervisory divergence. So it's a tension, between being very specific and at the same time, not to overburden companies. But I think that we heard this message because if I go back to the Listing Act that the minister mentioned, for instance, one of the big things that we want to do is clearly to cut the red tape and to, I would say, create an environment where there is, for instance, when you want to access capital markets, when you want to access equity markets and stock exchanges, when you want to do an IPO, you have less information to provide while maintaining a high level of investor protection. So I just want to highlight this tension, between having on the one hand something which ensure investor protection, financial stability. You were mentioning AML, so market integrity. But on the other hand, we need also to have an environment which is conducive to investment. So, but it's difficult to find the right balance.
Any other questions? Yes, please.
Mateo.
Over here. Lady here. Right here. Sorry. You.
I got one question too.
Go ahead, and then we'll...
I've got a microphone. Mateusz Szczurek, EBRD. You mentioned capital markets, regional capital markets union. Is that perhaps a second best solution if we're not able to get the first best of a pan-European capital markets union operating very quickly? Maybe coalitions of the willing are the intermediate option. And maybe more specific question is, do you see other countries joining Baltic Capital Markets Union initiatives, being sort of expanding, maybe at the end, encompassing entire Europe? Is that, do you see other countries sort of interested in the initiatives that you mentioned, Minister?
Interesting question.
Yes, one side is second best option, yes, because generally we are advocates of the European Capital Market Union and Banking Union as well, but it's really hard to move for all member states at the same speed, and the discussions at the European level are really slow sometimes, and these discussions are very technical, and that's why I think it's they're even slower, just because it's very difficult to understand all the details and all the consequences, because you have to keep in mind the risks and at the same time opportunities, and to have it in one point and one compromise is really difficult. To move for free countries like Baltic states, yes, it's faster, but the capacities of these countries are not at the same level as the European Commission stuff is working, and the capacities are really not at the same level. So I think there is both sides. You can move faster just because to agree on something is easier, but the capacities to prepare the solutions are not the same as European. So we are moving maybe not so fast, but we are increasing a bit the capacities of our Baltic businesses to attract the investors, and also to creating opportunities for the investors to invest in and have bigger choice of those free countries. So there is a different sides of the story as always.
Romantas, yeah, very briefly.
Just 2 words, Mateusz. Of course, I'm very happy to see you here. We worked together at the ECOFIN table some time ago. The idea came from the reports of the European Court of Auditors as well. We issued one of the recommendations to the Commission. The Commission should promote proactively regional projects of parallel legislation and arranging market instruments for some logical regions, of which, of course, Baltic region is logical. The more so that there was work done previously by the EBRD and with participation of the Commission. It's funny that Commission was reluctant to accept this recommendation. They said, no, subsidiarity principle. But I think that is very wise. If you want to build a building, you should take bricks and put them together, starting from one of the walls. And this is what is happening indeed in the Baltics. A very good example for all European regions.
Lady here, yeah.
Ruta Skirienė, Investors Forum. More local question, I would say. As recalling from my previous life in Ministry of Finance, we are developing capital market local all that time. Maybe very shortly from Minister would like to hear, are you going to introduce investment accounts, so-called, to encourage ordinary people to participate more actively in capital markets? Thank you.
That's the question I was expected to receive today. The tax proposals to the spring session of the Parliament is a most wanted secret now, I think, and as I said, it's a window for opportunity waited for everybody. So I think that it's not a secret that in a package that was proposed to the coalition partners, there is idea about investment account, investment saving account, but we have to create the model. So if we're creating the model, some of the exemptions that are existing now must go away, and we must create different model with the investment saving account, and I think it would be very beneficial to some small investors. And but when
I have to say what is going to the parliament. We must understand that it's not only the ideas and proposal from my side, but at the same time, we must agree about all the package of the proposals itself. So if we can agree to create different model without the exemptions that are existing now, I think we can move with the investment savings account that was discussed, and I think it would be a good way forward.
Please.
Yes, I think I have the question to Mr. Kame. What do you think regarding the new active things to support the industry in the United States? Now the EU going more or less the same things, and China announced that they will spend $500 billion to support their own businesses, on productions, to keep, let's say, to keep the companies from Europe, from United States inside the China, because a lot of movements now are coming, especially to United States, and maybe in the future some companies will come back to Europe. What is your opinion how it will influence the capital markets in general? What is your opinion? Maybe the questions to Mr. Kam and to Mr. Wright as well.
Yeah, first a point on the Inflation Reduction Act in the US. The good thing is that the US is moving on green, and I think Europe and the globe should be happy that this is happening. And when it comes to subsidy, when it comes to carbon taxation, when it comes to regulation, there are a number of instruments you could use in terms of moving on the green goals. What you should avoid is domestic protection, impacting on trade flows. That is not useful. That is an issue, and I think the US administration indicated that they are trying to address it, and I think what we are seeing in Europe is to deal with the spillovers of that. Your point is a broader one and a very important one. The world has benefited from globalization immensely. That has benefited the poor, that has benefited the advanced economy. And when you start fragmenting, in terms of trade, you start fragmenting in terms of technology transfer. That is going to be extremely costly in terms of global growth, and it's going to affect everybody. So what we strongly believe in is that we need to maintain a multilateral, rules-based system which allows everybody to benefit from that system. Now, having said that, we also come out of the pandemic, and one lesson from the pandemic is lowest cost is not always lowest cost in the medium term. And we saw how fragile supply chains in the end were. So there is an argument to become more resilient. But more resilience doesn't mean homeshoring, onshoring, because resilience means, in the end, diversification. You don't know where the next shock is going to hit, and so you need to be diversified. And I think that's the right way of dealing with these kind of issues in terms of resiliencies. Fragmentation is the wrong way of responding.
Well, we've unfortunately run out of time after a delay, and I'd like to thank all the staff in the hotel and for getting us up and running. A difficult situation this morning. So if you all agree, I'd like my panelists to give them 1 minute each, to make their final remarks before we have a very well-earned coffee, I think. Rimantas, 1 minute.
In 1 minute, probably I can make a bold proposal. When you are sunk in some difficult, problematic, sometimes a good idea arrives that first looks crazy, but then everybody agrees this is something that is needed to do. With Capital Markets Union, this is European single access point. computerized system, ESAP. There are problems, but European Parliament already yesterday, I think, or the day before yesterday, agreed on their position on that. Court of Auditors proposed another, this is ESAP, a SIP, European Single Investors Portal, where you could find all the data about all the funds in the European Union and probably outside the European Union. I think this could be a breakthrough for tech-savvy people, and I think this could be another idea to catch up for some smart startups in Lithuania to start working on that. So this is my wish. And welcome to fourth panel, yeah, which will be discussing things like that.
Florian, are you still with us? 1 minute to tell us we should be optimistic.
No, I think that we should be optimistic, because I think that each time that we have a crisis, which was, I mean, the 2008 crisis, and then, I mean, the pandemic crisis, the Brexit, then the energy crisis due to the war, and now that we have this competitiveness issue, each time we say we need to have capital markets well functioning. The European Commission is working on it. I think that the actions that we are proposing are very important. We are dealing today with the structural problems that we have to integrate the 27 national capital markets into one. I think it's true for the insolvency proposal, but I can also say what we are proposing on the retail investment strategy or on the withholding tax as well. That is a problem that we didn't mention, but which is important. We have our proposal on ESAP, which was mentioned several times. But I think that it's also important that to remind everyone in the room that it cannot be just a top-down approach. I think the bottom-up approach and what member states are doing is very important. For instance, on financial literacy, which was mentioned several times and which is an issue very close to the heart of my commissioner. She's very interested in that field. I think that it's very important because, I mean, member states have also a key role to play. And I welcome, for instance, that the Capital Market Development Action Plan of the banks of Lithuania is raising this point very clearly. I think that there is a role to play. We can help, but we have limited competence in education. And I think education, as Mr. Zetzius, as the minister said, is key. Financial literacy is key.
Alfred.
Yeah, investment needs in the European Union are large. Energy security, green transition, digitalization, you name it. NGEU was a big move, it was a good move. It is going to incentivize structural reform, it's providing investment, it's also helping on the bond issuing side. But we need to tap into the private savings in the European Union. And in addition to the capital markets union, the banking union is critical. And when you're looking at banks, large banks have an immense repository of knowledge on capital markets issues. So advancing not only on the commercial banking, on the capital markets union, but also on the banking union is critical. And much, much more needs to be done there. Yes.
Thank you. I think a lot of was said today. What's really important from my side, I think it's really important to move in all the levels that are there. And the European Commission has done a lot of work and in harmonizing everything what's in the different countries, and a lot of still to be done. But it's really important because it will have a huge effect. But anyway, if the process up there is slower, maybe we can move faster in the lower levels to harmonize something what can be harmonized in the Baltic states. So we're moving in that direction as well. And looking at the country's perspective, how to create the ecosystem that could help to give the competences from the bottom to above, that's our job. So we're creating the plan and the guidelines for capital markets
guidelines for upcoming 3 years. We're creating the green finance plan for upcoming 3 years, but at the same time, I would like to mention another plan that we're creating, that you mentioned, financial literacy, and I think it's a really, really important issue, and we're making another plan which will be over quite soon. So it's a financial literacy increasing plan, and we are dedicating it to the maybe three main groups. That is, I think, the financial literacy in their groups are needed a bit more than to the other. So one group is children, another group is seniors, and the third group is SMEs, because SMEs not always know how to apply to the funds, how to participate in the capital market, and the best solution for some of them is just go to the bank. And if the one bank says no, for some of them everything is over. So maybe to give the knowledge about all the opportunities that are existing, it might help to the capital market evolution in our country as well. Thank you.
Well, thank you all. I'd like to make 3 comments, and then we'll have our coffee. First of all, to thank you all. I think it's been a very rich discussion, and we've covered a lot of ground. I think there's great value in a consistent effort to build the capital markets. And I believe that international investors now are looking towards Europe in a slightly more positive way, because they are seeing what is happening. And I think it is important what you say, Minister, that we're flexible enough in Europe to allow local initiatives, to allow local cultures, and we have to be adaptable for all people to be in the ship. So as long as it's compatibility, that, in my view, can work, and can work well. The second point, you know what Florian said about bureaucracy, and it's an important question. Well, let me just tell you one thing. You look at the American rule book. It's multiple sizes bigger than our rule book, I can tell you that. I remember Paul Volcker, the chairman of the Federal Reserve, the great big, huge man, he came pounding into Brussels and said he was very much in favor of the international accounting standards system. And he came in and said, this is the best system for the world. You should be the first to adopt it, and we were in the European Union. And he said, there isn't one person on the face of the earth who understands the US accounting system. 100,000 pages of rules. And that's just the accounting system. You look at the securities rules, the banking rules. The United States has enormously complex rules, but what they do have is one market without barriers, which was your point. So we in Europe, I don't think this is a question so much of size of rules, it's clarity of rules, and it's making sure that we don't have barriers between markets. And that to me is the key. And if we can do that and keep moving forward, I think we can be successful. And this is my 3rd time here, Minister, thanks to you and your very kind invitation. I'm a little bit more optimistic. In spite of all this terrible war, which is so costly and terrible, we're making a bit more progress. And Europe actually has advanced in the areas that we've been talking about. Maybe not fast enough, but we're making progress. Thank you all very much.
Thank you very much for this fruitful panel. I will take 1 minute as well for a very, very short wrap-up of what has been said to develop resilience. We should coordinate all the support packages, state aid more if we want to preserve single market principles. We can build resilience via structural reforms, green transition. Unpleasant reality, unpleasant challenges we are experiencing, they are long-term problems and we should have long-term solutions for them. Priorities, single market tools, we should make full use of European institutions. Capital Markets Union, very relevant in the context. If it existed, we would already make good use of it. It's a problem of culture. Trust is something that is difficult to impose. Financial literacy of elites is needed as well. We have not done sufficient work in terms of Capital Markets Union. Heavy lifting should be done by the private sector. Public sector should be catalytic. EU action plan, transparency, insolvency, oversight. Progress has been slow. We need to accelerate moving to the Capital Markets Union, starting with lower levels. Thank you everyone so much. Thank you, the audience. Let us come back here at 11:30, have a good coffee break, and we'll be back for the second panel soon. Dear everybody, welcome back. I hope you managed to enjoy some coffee. We will kick off with panel number 2, Business in Turbulent Times, Access to Finance Unlocked. And I would like to give the word to the moderator of our second panel discussion, economist and president of the Lithuanian Banking Association, Ms. Eivilė Čipkutė. Let's welcome her warmly on stage. Thank you.
Welcome back after coffee break. So now, in the second panel, we are going to look at the business access to finance, and that is actually at the core of the Capital Markets Union and the issue that the Capital Markets Union is trying to resolve, and that is to provide more opportunities for businesses in Europe to finance, and that is mainly relates to the alternative to the bank lending, because what we know in Europe, businesses are heavily reliant on the banking financing. It's not bad, but we would like our businesses to have more opportunities to get access to finance in different economic conditions. And so the situation in our region is not much different as all over Europe. We could just add that in our region, the share of SMEs is even higher than the average of the European Union. It's around 99% of the businesses are SMEs, and so SMEs access to the capital markets is also will be an important part of our conversation. So our panel will be structured in 2 parts. At the beginning, we are going to have a fireside chat to give us an intro into our conversation, and it is going to be around 15 minutes, and after that we are going to have a panel discussion, and at the end there will be time for your questions. So for the fireside chat, I invite Jürgen Richtering, first Vice President and Head of Client Service Group at the EBRD, and Andrius Načiajus, Head of Luminor in Lithuania.
No, it's not working yet. Now it is working. Very good, Andrius. By the way, we met each other on screen, so we obviously use our first name. Very good to see you in person, and very good to have this informal chat. I know it's called fireside chat. I think given the temperature in the room, it would have been nice to have a fire in the background. But look, let's start with I would say quite an obvious question, and we've seen a significant sell-off of Central and Eastern European assets after the invasion of Ukraine, and by the way also throughout 2022 for that matter. It's not only true for Lithuania, it's not only true for the Baltics, it's actually true for a wider region. And in fact, this was one of the reasons why you see, for example, EBRD, the development bank I'm working for, having to step up, having a record year here. We invested more than 200 million last year. But of course, we were not able to make up this significant gap. So, Andrius, first question, has something changed during the past weeks, or probably as differently? Do you expect to see a normalization for the remainder of the year? And I'll also say that because Luminor, the bank you're working for, recently actually had its own issuance, and we actually did see increased demand again. We did see a price tightening of the price. Is it a green shoot or is it more?
Thanks, Jürgen. Very good question. Yes, you're entirely correct. There's been a change of market appetite, considerable change to negative last year in the Baltics. And if I just kind of illustrate a bit on the numbers, so in the debt capital markets, which is a bigger market from the public, I will talk about public markets only. 2021, we thought that, finally it took off, right? We had in the primary market issuance, 2.2 billion euro issuance that's excluded financial institutions for corporates in the Baltics. And that's actually already a sizable amount, right? 2.2 billion in the Baltics, that compared to bank lending of around 10 billion, which is, 22% of the bank financing. And unfortunately, 2022 came in, and then this market contracted considerably to around 600 million euros of new issuance. And the spreads and the financing cost rocketed considerably. I could just, for example, give you an example on the banking market, and banks have to issue bonds because of MREL requirements. So bank bond yields were around 1% in the primary market. We could finance ourselves and other banks at around 1% in 2021. Today it's 7-8. This widen, of course, part of it is interest rates, but major part of it is actually credit risk premium and geopolitical credit risk premium. For me, it's also a little bit sad because when in 2021 in debt, I'll come to equities as well. In debt, we were saying that Baltics are priced, same credit risk is priced at Spanish and Italian levels, which is not fair, right? We're much better than Spanish and Italian corporates. Today, that spread is double. Same rating, same metrics, spread is double in the capital markets. And of course, the demand subsided. A lot of it was refinanced in banking market. Thank God for very stable and solid banking market in these countries. Otherwise, we would have seen much bigger impact. Equities, it was even more dire because it went from around 600 million of issuance in 2021, of course, concentrated on two large issues, one in London, one in Tallinn, to basically zero last year. So, and on the last part of the question, do we see any change in appetite? Yes, a little bit, a little bit improved, but from very high. Like as we mentioned with the Luminor transaction in January, yes, the demand was there. The demand was wide from the whole of Europe. But to get to that demand, we needed to pay a quite solid price, right? So 7% of yield for us, that's expensive. And the demand was there because the yield was very attractive. So there is still a very considerable risk premium for Baltic issuers on the debt. And equities, you could say, are still pretty much closed unless you tap into local investor base, which is here. Maybe just one additional thing for last year. As you mentioned, EBRD played a very crucial role, to step in this vacuum of demand, and of course our pension funds, which are geared towards the local market. So definitely thankful for them as well.
We didn't pay him to say something nice about EBRD, by the way. Last week we had a Zoom call and we went through some of the questions, so it's not very fair to immediately deviate, but it's actually from what you just, you used the word equities. And during the last 1.5 days, I continuously in one of my meetings, I said, tomorrow I'm sitting here and I'm sitting with Andreas from Luminor, and of course they're doing a great job, but what can they do better? That's always a good question. And people actually said, yes, you're really doing well on the bond side, but capital markets is much broader. You mentioned equities yourself. So how do you see your role on the equity side? And by the way, one little footnote, one person said, well, how about a listing for Luminor themselves?
Yeah, so there's two parts, right? What we as a Luminor could do, or maybe what we could do in the equities, and then second about our listing, potential listing. In Luminor, yes, on the debts we do have a very good and dominant position on the primary market. We pushed for that intentionally because we saw that this is the market that is about ready to take off, and luckily we were right. Equities, we will go there. It's just a question of timing. So I think definitely this is one of our priorities as well, because we quite naturally, having done a lot in debt capital markets, we want to push into equity capital markets as well at some point of time. Just as I mentioned, that the situation in equity capital markets is quite dire today. So making big investments in that field fast is maybe not very good financially yet, but at some point of time, yes. As for Luminor, the shareholders, have to comment whether they want to list or not. But I always, tell also to employees and publicly that for us the main job is to become sufficiently profitable first, right? And we're still some way to go there.
Thank you. We go back to the debt side, and we go back to your own issuance a few weeks ago. When you look at the order book, investors actually in the UK accounted for almost half of the total order book. What do you think this indicates? Because we have seen hardly any investor appetite actually from across the big pond in the US and beyond. So, and what would you say to a US or UK investor sitting on the fence and contemplating a return to the Baltics?
Maybe the way I would put it in our order book, it's not really UK investors, it's a global investors which are domiciled in UK. So what happened in our latest issue was that we managed to attract the global investors which were domiciled for the European operations in UK. What needs to happen to attract the global investors is very difficult typically with your first issues, right? So for us, it's already 1, 2, 3, 4, fourth or fifth issue. You get a critical size, you get the coverage, you talk to them for a number of times. Last issue was also a rather attractive yield, and then they made the move.
Thank you. When I mentioned about the sell-off in the markets, it's in general true, but we've seen that actually bank issues have, in general, seem to have been less affected, and we have seen hardly any corporate issues. From the information I received, and actually it was also in one of the Luminor presentation, I believe that there are sizable corporate bond maturities across the Baltics during 23, and I think you estimated it to be around 1 billion euros. So do you think that these are likely to be refinanced through the capital markets, or would, for example, bilateral loans by you or us or other institutions be more likely?
So first I'll comment on why the bank issuance has held up last year. That's true for us, and that's true for other banks for which we have run the issues. Banks do not need funding, wholesale funding. Banks do MREL funding or bond funding as we do, right, only because we are required by law. So it's a regulatory requirement to have so-called MREL eligible funding, and we need to issue. We wouldn't issue, at current market price if it was not a legal requirement. So that's why the bank issuance has held up, and it will hold up in this year as well, because there is, certain requirements that banks need to meet. The question is when they choose to do that. As for the corporate bonds, yes, I mean, it's around 1 billion euros maturing this year, and our guesstimate is that quite a large chunk of it will go into the banking market. Just because, again, I say, luckily for this region, the banking spreads have actually not adjusted much on the lending, or not at all, while in the capital markets they have widened considerably. So for corporates, of course, once they have a choice, then they'll go probably for the currently cheaper option, which is bank financing.
In the previous panel, actually the focus was also on SMEs. And when you look at the EU-wide survey, which is probably not surprising, it finds that European businesses, particularly SMEs, they find it probably even harder this year to access capital markets, and certainly well, I would say not even capital markets, access to finance is probably even better, and if so, with deteriorating conditions. How is that in Lithuania?
So here, Lithuania, I think, is quite well placed, even if maybe someone would say that it's in a bad place. But just simple figures: Lithuanian loan-to-deposit ratio is around 70%, meaning that banks are still have excess liquidity. So there is inbuilt quite a lot of motivation to lend that money, and the banks are quite locally biased and quite lending product biased, right? Unlike in many other regions. So what we've seen in some other countries in Europe where there is actually a shortage of funding for the banks, there is, NPL books, increasing quite rapidly. We do not see that yet here, and definitely there's no shortage of funding. So I think here, in this spot, we are in a very good position. If we, I also sometimes draw a parallel because when COVID started and Ukraine war started and everyone's saying, some started saying, well, it's going to be 2008. Again, it's not. 2008, Baltic region, including Lithuania, were overstretched considerably. Like if you look at the banking market, which still dominates definitely the financing, the loan-to-deposit ratio was around 200%, meaning that 50% of funding for banks in this region was coming from abroad. Today in Lithuania, it's vice versa, right? There is excess of liquidity, there is excess of funds. So, it's very unlikely that banks will pull the funding out. And that's a frankly, very good situation to have.
Thank you. And perhaps lastly, I already get the look. No, be short. Some of us here a few weeks ago were in Davos for the World Economic Forum. And I personally was quite surprised by the positive mood there. No, I mean, there was really this upbeat mood. Interest rates are still going down, but everybody agrees inflation has peaked. So therefore, interest rates probably will go down again at a certain point in time. China is opening up. We will get a big boost from that. We heard about the IRA, the Inflation Reduction Act, the US jumping again on the green bandwagon, etc. And many economic, smart people, chief economists, they actually have increased their forecast again. I personally don't buy it, but maybe I'm not that smart. And I believe that there will be another black swan event somewhere around the corner. And by the way, for the people who do not know, a black swan actually does exist. It is a water bird in Australia. So it's not something which is very, very strange. So from your perspective, from Luminor's perspective, besides the uncertainties around Ukraine, what else do you think? What else do you put in your stress testing? What concerns you?
You're probably, most of the thing that concerns us is our internal issues, but that's not probably about it, right? Other than internal issues, yes, there's, of course, in the stress it's persistent inflation, it's hike of interest rates, not, to 3% or 4%, but, to 5, 6, 7, 8, right? How we will deal with that. It is a fragmentation of the capital markets globally and fragmentation actually of European Union. These are the things that we worry about that will have a definitely negative impact on us. Other things that we read in the press and so forth, I think I would say it's business as usual, right? Raising interest rates are here, right? They will rise, right? Persistent inflation and core inflation is probably here as well. In our stress test, what we worry about is, of course, this very much black swans, which it's very difficult to imagine today, but could happen and could disrupt our business.
Well, thank you so much. I think I will now leave the stage. I think the grilling for you continues, but thank you so much for this very, very nice conversation, and over to you.
Thank you, Jürgen. And now I will invite the rest of the panel to join. Andrew, please stay. And we have Björn Sibern, President, European Markets at Nasdaq. Gediminas Šimkus, Governor of Bank of Lithuania. Jonas Rimavičius, CFO at Ignitis. So, on the fireside chat, I have to say it was also very positive. The same as in Davos, that's the mood. It continues like that, and we have a strong position of the banking sector, and it is a continuous trend. We can say whatever happens, it is like that in this region. And so, to start our panel discussion, I want to ask Governor to provide his views on what is happening on the Baltic financial sector, what is the overview, the banking sector, and also other maybe parts of it which are relevant for the capital markets.
Well, thank you and good afternoon to everyone. I think that's a very good question. And it kind of digs into the essence, what's the Baltics financial sector? We talked a lot about the capital market and actually about the need to develop it. But in the reality, in the essence, the financial sector in the Baltics, basically in every Baltic state is so the financial sector is very much banking sector. And then you refer to the panel's question, unlock or locked or unlocked the finance. So it's very much about banking finance and they want to change. What's kind of makes similar the Baltic states? So as I said, this is bank-centric. This is largely the same banking groups. And this is and high concentration. And in this turbulent time, the most amazing thing I would say is that banking industry is at the best shape. Andres mentioned ample liquidity and no need to borrow in the markets. Capitalization is high, profitability is high, and loan quality is one of the best in the European Union. And of course, this can be this situation, this extraordinary, I would say extraordinary good shape of financial system, because it's banking-centric in the Baltic, is explained not only by step up in the efforts to protect the banks, but actually it's the efforts, build up of the efforts, how to build, generally to build the strengths of our financial system. And here I can start with the membership in the EU, and we have much lower interest rate volatility. The foreign currency risks are completely of a different scale and scope than we used to have before the Euro area membership. And what's also matter, this is the possibility, the potential of the support that could come not only from the monetary policy with ECB behind, so the different size of it, but also of the fiscal potential help for the fiscal policy, because we are in the same Euro area, so to say. It's also the framework, or institutional framework that we built since the global financial crisis. Lithuania, but actually each of the Baltic states is the members of the banking union. Very close and efficient coordination between collaboration of the supervisory authorities among the Baltic states, but also to the supervisory of the country of headquarters. Macroprudential framework that is very efficient, and I would say the leading example of macroprudential framework in the world is actually in our countries. So all in all, I don't mean that there are no risks in geopolitics, macroeconomics, high inflation, tighter financial conditions. They are passing through our economies, they have an impact, but at the same time, due to the specifics of our banking industry, it's also leading, as I said, to this specific, I would say extraordinary, exceptional good situation in the financial sector of the Baltics.
That's indeed. No, especially actually on Europoint, couldn't agree more that our countries, all of our region would be completely different if we didn't have euro. And but now, so thinking about the capital markets, given that, as Governor noted, our banks and all in all banking sector is so strong in this region, right? That is to an extent perhaps a reason why it is so not easy to develop local capital markets. And Bjorn, I wanted to ask you, how do you assess the success and overall progress of Capital Markets Union Action Plan, which should also work in this region? What achievements you are happy about, and then maybe anything that concerns you?
Okay. That was a good introduction. So we have heard that there have been many positive views, and I will also start with a positive view, but I'm also turned negative. So now you're prepared. So the positive part, think about what happened during COVID. We have super high volatility, a lot of uncertainty. The financial markets, and here I'm referring mainly to the equity market, worked super well, right? Spreads were low. It was easy for investors to get in and out. It was possible for companies to raise capital. It was possible for already listed companies that needed to strengthen their balance sheets to get access to capital, either through equities or bonds. It was possible still to do IPO just 6 months after COVID. So the financial markets worked super well. And when I compare to the situation back in 2008 and 9 during the financial crisis, where we have massive spreads, difficult to get access to capital. So if I should stay positive, I think actually the system, the financial systems, not only in Europe but across the world, is so much more robust and resilient versus previously. So I think that was positive. On top of that, we got a lot of retail investors into the market, and I'm happy to talk about that a little bit later. If we should then look at the Capital Market Union, the great performance on the financial markets in terms of liquidity, spreads, and so forth, is that because of the Capital Market Union? I doubt that. And when I look at the Capital Market Union, I feel like I'm sitting here after 10 years having the same discussion around what should we do more and better to help SMEs. This is something that is super important for me, super important for NASDAQ. How do we help SMEs grow and get access to capital? And there are some good intentions in the Capital Market Union. When I look at the Listings Act, smaller, lighter prospectus instead of 300 pages, no retail investors would read 300 pages in a prospectus. Now there is some ideas about how to shrink it down to 75, 60 pages. There are ideas about lower free float requirements, which is good. So there are a couple of good intentions, but I feel it's working so slow. So when I look at the Capital Market Union, I feel that we are moving so slow, and we do not really put our best foot forward to really help SME companies to grow. And I just want to do a small turn to what a discussion we had in Sweden. I'm Danish, and the Danish capital market does not work super well versus the Swedish market. But Sweden 15 years ago, the political landscape in Sweden said, we want to strengthen the equity market instead of bank financing. We want to make it much more attractive for retail investors to invest in equities. So, and this is not because of the Capital Market Union, this was a political decision in Sweden. So this started a journey by implementing an investment saving account. I can highly recommend it. Do it as fast as possible here in Lithuania as well. But in Sweden, they invest in an investment saving account. Now that they have more than 3 million out of 10 million Swedish investors investing in equities. And it's not that they do crazy bets in small cap companies. They put 5-10 bets, investments in some of them, some of it's SME companies, and they grow fast. Companies that list on First North in Sweden, the growth market, they create 3 times more jobs than their benchmark. They grow faster. Instead of just having a growth plan just for Sweden, they grow into Europe, they grow faster. So my point is, I feel that the Capital Market Union have many great intentions, but we are moving so slow. And sometimes the countries themselves can have ideas, execute and implement something that works much, much better and faster, sometimes despite Capital Market Union.
That's true. That's a very interesting example that you give from Sweden, that 3 million out of 10 are investing. Actually, we also have a goal, a dream for our market, which is less than 3 million. We want 1 million people to invest. That's so. We have the goal. We just have to, find the means to reach that. And of course, the Capital Markets Union. So everyone agrees that we are moving too slow, and it's an interesting point that perhaps individual countries or at least regions could do something in addition or to move ahead given the context. So and Gediminas, I would like to ask you in this context, so how could central banks or regulators contribute to deepen local capital markets? Maybe you have some plans, and also given that our Baltic markets are small, right? Just if we add all of them, it's only 6 million people. So maybe you have some plans or ideas how we could do that together, and also from the regulatory side.
Well, I very much agree with Bjorn, who said that the potential of EU-wide capital market is unlocked and they're moving too slow because of the lack of consensus between EU member states, and discussions are stalling. And of course, this in a way creates a chance for us to work on our regional capital market. Either it's a Baltic states capital market. I would like to talk also about Lithuanian capital market, but we shouldn't kind of be naive that much that we can develop it just in our countries without taking into regard the neighboring countries such as Latvia and Estonia. So it's really about the Baltic capital market, and many companies that work in Lithuania, they also perform activities in neighboring countries, in other Baltic states. But lead by your example. That's what I think. And this is where the Bank of Lithuania, Ministry of Finance, other institutions took leadership, and we developed the capital market development guidelines that were approved by our government. And among many other measures, such as investment account is there, improvement in legal regulation, improvement in tax environment, increase of the provision of new financial products, step up of financial literacy. So all these kind of measures are in this there. There was a question in the previous panel, and it was very right. So this is not the first capital market development plan. So what are the reasons we're still kind of developing it? In fact, I think we have the opposite direction. The capital market was shrinking in Lithuania, not growing, even if we have had already a couple of capital market development plans. And I think it's, first of all, the need to understand that capital market is not the responsibility of one or another institution. It's a combination of the efforts of different institutions. Therefore, the implementation, or actually the governance structure, is crucial. And I'm happy that we managed to create a holistic governance structure where Bank of Lithuania, Ministry of Finance, other institutions, but as well as the market representatives take part. And the second thing is that you need to know what you want to achieve. And in many cases, when people talk and discuss capital markets, they start and end with the possibilities to issue more papers, or in an easy way issue securities, equities in the market. But the market needs liquidity. And this is where the investment account steps in for retailers to step in, to invest not only in deposits, if you can invest in deposits at all, but not to put your money into deposits, but to invest in the market, into the market you know the best. This is your closest market, one thing. The other thing, we also need, maybe I could call it like institutional investors. We need to know our market. And if we want, and we see the capital market in Lithuania in its development, not from the point of view that we would need more securities, but this is a way to increase the competition in our financial system. Because as we began, our financial system is very much bank-centric. So empowering capital markets, this is increasing the competition, improving the access to finance for many companies, and what's very much important, not only for big ones, but also for medium and small enterprises. And the last point, on the need to work on the regional or Lithuanian capital market, this is to unlock the potential for new companies, which in many cases might find difficult to attract financing typical credit providers as banks because of many standards and this. So in the equity market, more risk can be taken by the investors, and this unlocks the possibility for business growth in the area of startups.
Thank you, and I like the idea to lead by example, and I think we actually, especially in this country, we have this potential because, for example, if we take Skype, which became an inspiration for a generation of Estonians to come up with ideas and to have an imaginable number of unicorns for such a small country, right? It was an inspiration, was enough one worldwide company. So what we did in last years, we managed to become world-known hub for fintech, right? So we already have the playbook. I think we could just use it to transfer it to another goal or to additional goal, and that is more related to, say, capital markets or green capital markets. And so to continue a little bit conversation on the regulatory side and more context, Bjorn, you have a lot of experience all around the region. You know how different markets work in Europe. So I want to ask you, how active are the SMEs in the Nordic region in using capital markets, and what would you suggest for the Baltics to learn from, or what could we do?
Yeah, you mentioned the playbook, and I alluded to it earlier. So 15 years ago, there was a lot of discussion in Sweden around why do we need an exchange? It's difficult to raise capital. It's difficult for SMEs to get access to capital. And as I mentioned, the government sat down together with different stakeholders and said, we need to do something about it. We need to make sure that it will be much easier, cheaper for retail investors to trade equities. And they invented this concept around investment saving account. And the 3 million I was referring to was 3 million investment savings account in Sweden. 80% of all adults own equities in Sweden. So they started this journey 15 years ago. And that was on top of a lot of discussion. It's so difficult to get access to capital for SMEs. So they started that. It is a long journey. So they started the concept of the investment saving account, and slowly the market grew. Sweden is the leading listing venue in Europe. Sweden attracts more new SME companies than UK, than Germany, than Spain, than France, right? And why is that? A big part of that is the investment saving account. So when we see new companies listed on First North, and First North in Sweden have more than 400 companies listed. 400 companies, right? Those companies, when they, let's say it's a company with a market cap of 30 million euros, 40% of that capital comes from private investors, 40%. 60% is from anchor investors and institutional investors. So a big part of that is retail investors. And also when it comes to the liquidity, so the trading afterwards, 60% of that is done by retail investors. So Sweden have really built a system. When retail accounts got popular, the banks, advisors, the pension system start to adopt and tap into that new ecosystem. And the beauty with the saving account is also, by the way, from a tax point of view, the banks report the tax. So the retail investors don't have to do anything, and the government knows that it will get the money. So it's a super simple model. So that's the playbook. Then I was sitting in Denmark saying, we should just in Denmark, because we struggle with the same, we should just implement the Swedish playbook. And I went to all the political parties in Denmark and proposed it, and they said, yes, what a great idea. And then went through the process, and we got something that looked like 20% of the Swedish model, and it half failed. Finland and Norway have implemented similar models like Sweden, and they have been successful. I think there's around 2 million saving accounts now in Norway, almost the same in Finland, and you start to see SME companies go to the exchange, list, get access to capital, and again, back to my point, they grow faster, they create more job, they create more wealth for the society. So the playbook is there. It's just go ahead and implement it. And David Wright was spot on. We have a huge gap versus US, but this is one way of creating a much better ecosystem. And my final point, and I promise to finish, when the market works so well for SMEs, it also helps the larger companies. Volvo Cars listed 2 years ago in Sweden. They got 200,000 retail investors investing in that company. Volvo Cars, they could have decided to list in US. They decided to invest in Sweden because the retail market, the institution market, the mix, the liquidity pool is so strong, so it was better for them to list in Sweden versus to list in US. So it helps the whole ecosystem with the retail saving account.
Yes, indeed, it requires a whole ecosystem, but it sounds to me that your advice would be to start with the demand side. And of course, the immediate job that we should do is to have an investment account that would facilitate the investment for retail investors. Perhaps just if I translated your advice, because we are thinking about demand side and supply side, and it sounds like the demand side that's where we should start.
If you create the investment savings account like we saw in Sweden and companies start to see, it is actually possible to get access to capital. And of course, COVID have also in some way helped the interest for retailers towards equities. So the momentum is great, but it can be complicated, difficult to start trading. If you have an investment saving account that makes it easy, and we as an exchange, we also have a big responsibility in being a part of the education around it. So we educate new future investors around what is it to invest in equities. So it is a long effort and it takes time. But if the SME companies see you have a big investor base, local investor base that is ready to invest, they will use that opportunity. That at least the experience we have seen in Sweden. Now we also see it in Norway and to a large extent also in Finland.
Thank you. And so now moving on to a bit more closer to the issuer side, and also Luminor has facilitated a lot of issuances, so you as a financial intermediary also see how the process is going, what are the questions, and how the companies are making this decision. And I want to refer to the fireside chat, and then you noted that issuance volumes dropped in 2022. So what are the big blockers that we would need to remove to expect long-term growth of bond and equity capital markets in the region?
As I also mentioned, it was driven, of course, by a change in market sentiment, for sure. If we look at the long-term kind of, impediments and what we could do better, I couldn't agree more, actually. Both the governor and Björn, they mentioned demand side. For me, it is not about the regulation. The regulation, the regulators, the environment is actually, you always want it better. But it's quite good. It's compared to US, it's much better in Europe overall, and in this region specifically, it's much better than anywhere else in Europe, right? So it's not that we are, very bad regulation or very clumsy. No, it's actually quite straightforward, relatively straightforward. But the demand is an issue, for sure. Björn talked a lot about, how to spur the retail demand, and the Swedish example, which is, remarkable. Definitely retail investors are needed, though I would say if we create investment account, which is also needed, I don't think it's this one step will bring us to Swedish or Finnish or Norwegian examples. Swedish, playbook was, they tapped on already investor base or, society that were already investing, right? So it accelerated, it gave, further tools, it gave, further liquidity to the local, markets and so forth. Here we start from very low base, right? So we don't have, the retail base, and Vito does, we'll talk in the other panel probably more about, what to do with the retail investor base. We also don't have institutional base, right? We have fragments of it. We have pension funds who are, investing in this region, which is very glad. We have a BRD, which is here, right, and supporting, but that's about it. And then we have, of course, Western investors or foreign investors who come in or come out, and they also have their size requirements. So my additional, maybe to add on what is needed in addition to retail investors, is definitely wider institutional investment base here in the Baltics, right? That invest in local debt, in local equity. On that, as we see from Scandinavia, you can build on, you can accelerate, you can add a broader retail participation without, good institutional investor base, local one, stable one, is going to be difficult. I would also maybe mention another angle, which is supply. So, you always need a demand and supply. And on supply, one maybe big impediment, which is maybe not always voiced very loudly, is a bit cultural. When we talk to the businesses, especially the business owned by older generation, they are not keen at all, right, to bring in additional investors. The good signal is that the younger generation, they're very keen. They're keen to bring in investors, to scale, to grow. The older generation, less keen. So I'm quite hopeful, right? The generational shift, the good examples will bring that change as well. But there is a cultural resistance, of letting my company, letting the control out of my hands. But again, I'm quite hopeful. There's a generational shift. We've seen that Scandinavia shifting, and it will shift here as well.
Thank you. So it seems demand and supply, and also on demand side, not only the retail investor, but also we need to have a strong and stable institutional investors base, so to provide the constant liquidity for the markets. And that's, I guess, is a little bit missing. Pension funds is an important player, but we need more, and we need more stable. So it would be very interesting now to turn to issuer. And Ignitis is, well, everybody, I guess, know that Ignitis is a star in the Baltic region. We, as a Lithuania, we were very proud to have Ignitis on the market. And you have experience, you did IPO and also bond issuance, so you have seen it all, went through all, so it would be very interesting to hear your experience. How does it feel to issue equity and bond in our market?
Yes. So hello everyone. So indeed, by now we have issued 3 bond issuances, 300 million each, and did an IPO of 450 million. So we are one of the bigger fans of capital markets in the Baltics. And one of the first things you realize when you start preparing for the issuance on capital markets locally is indeed the demand side, right? The capacity of the local markets to accumulate or to let's say to buy into those issuances. And in the number perspective, the capacity of the Baltic market is roughly 100 million to 200 million at best, right? That's what the local market can absorb in a typical bond or equity transaction, which is not a lot. Also, if you take out, Swedbank, SEB, Luminor, you will probably will be left with tens of millions remaining, which is a very, very low number. So clearly there is a gap to be filled, and that gap should be filled with institutional investors. And until we build up our own, the foreign international institutional investors are crucial for this exercise. And then there is quite an interesting difference between bond issuances and equity, because in terms of attracting these international institutional investors. So maybe starting from the bond side, and then from our own experience, bond market has an important difference from equity, is that in the secondary market it's traded over the counter, OTC, bilateral contracts, which means that for international investors, it's less of an local, let's say, the listing location, the infrastructure is less important for them compared to equity. So in a sense, when issuing a bond, what international investors are looking at, it's pure business fundamentals, right? So when they are comparing where to invest, whether into Ignitis or other Western European utility, they are mainly focused on the business environment, credit metrics, those sort of things. And that actually works well. It works well for the local issuers, and it worked well for us. So to put it in the perspective, so our first 2 bond issuances were 5 times oversubscribed. The third one, even at the peak of COVID, where the markets were shutting down, was also multiple times oversubscribed. So there is a strong demand, and the international institutional investors are well positioned to invest in local names in bonds, right? Now let's move to the equity part, and here's the story is a bit different, and maybe not a bit, significantly different. And the reason is as I mentioned, that In the secondary market, equity trading goes through the stock exchange, and it is a very important component in decision making for institutional investors. So when investors are making investment decisions, they look not only at business fundamentals, they also try to understand several other things. So one is whether they are well set up to trade in the particular listing location. That's one thing. And the other thing is what is the level of development of the capital markets, right? And from our experience on both these things, we had challenges, because in terms of international investors set up to trade locally here, we actually asked more than 10 international investment banks to go to their customers and ask whether they are able to invest here locally. And the answer was across all of them was that investors are either unable to invest here because they are not set up, they are unsure how to set up, or they don't want to invest time in doing that setup, which means that it's already a big narrowing of investor universe. Then the second stage is in relation to the development of capital markets. So as most of you probably know, Baltic countries are not classified as a developed market. They are not even classified as an emerging market. They are classified as a frontier market, which is the lowest level of development. What it means that passive funds, which now account for 20 to 40% of the whole global stock market, cannot invest here, right? So there is no passive demand in the Baltics. The second thing is that for some of the active investors, it's the same issue, because they don't want to deviate from their benchmark, so they are not investing here. And the third bit, active investors who are willing to invest here, then they have naturally understand that the passives will not come, so they will adjust their return expectations, which means a more expensive cost of funding for the local companies. So, long story short, for the bonds, we are more or less okay. We can attract this international capital and demand is there. For equity, we definitely need to fix the ease of trading for international institutional investors, and we need to work on reclassifying from frontier markets to at least emerging markets. And those two things will make a significant difference for attracting the demand side for equity.
These are very interesting points, and well, each of them we could expand on because from the other side, the views, it's very clear the issues we need to fix, and of course some of them are more chicken or egg questions. I want to refer to Andrew's point where you mentioned that it is also a question of culture, where sometimes in the companies, the owners, current owners don't want to do IPOs, they don't want to allow other investors in. And I know you are a state-owned company, but still, perhaps you can provide some view on what does it mean to be listed and non-listed. Did your life change a lot as a company? And what kind of, for people who would be listening, is there anything to be afraid of, or how would you say on that?
So in terms of life-changing, in our case, it didn't change that much, because at least on the reporting side, we did that reporting anyways. I mean, the changes were mostly positive, and by positive, I could mention a few things. So one, when you have in your investor base, you attract these institutional investors, especially specialist investors who are investing across different companies in the same sector. Then through constant communication with them, you get the feedback loop both ways, right? So you present the results, but you get back what others are doing, where you can improve. So it gives you this immediate feedback loop from people who understand, what are the best trends in the sector. So this is a very important thing, I would say, which changed.
Thank you. And when you reflected on attracting investors, especially, of course, on equity side, and so it seems that institutional investors is the key, and not only the local ones, because there are some major ones local, but there are few of them, and they are quite active. All the banks are there, but we need to also think of foreign, let's say, institutional investors. And you noted some infrastructure issues or sort of questions in listing. And Bjorn, I wanted to ask you maybe to reflect on that. How do you see that? Because perhaps you have ideas and you saw how other markets have progressed and were able to jump over this threshold.
Yeah, so first of all, I fully agree with the point that if I look at the Baltic region, retail participation is relatively high already. It's more a lack of institutional investors. And of course, it has some historical reasons, so it takes time to build up. So I fully agree with that. So the institutional part is missing to some extent. And then the Ignitis case is just such a fantastic case. I think actually to make the Baltic markets bigger and more attractive for foreign investors, you need a couple of more cases. We need more like you guys that lead the way, because it got a lot of attention. And now Enefit Green that came on the year after, I know it was in one of the other markets, but of course it creates some, and I think it was 60,000 retail investors, a lot of attention. So just those two companies, at least on my radar, on many people I talked to, quite many people talked about it. So you need some of those flagships that lead the way, that open the door, and hopefully many of the foreign institutional investors are now set up because they trade your shares. But it's a journey, and that's probably my point, that it will take some time to develop that. And when you have some flagships that lead the way and show the way, then it's also easier to be inspired if you sit and build your own startup company and want to list. And again, think about if we could get to a stage where we here in the Baltics maybe had 100 companies listed on First North, growth companies that had the ambition to be as big as some of the bigger companies. By the way, in Sweden, we have had more than 100 companies moving from First North, the growth segment, to the main market, simply because they did so well during 10 years. So they became large cap company or mid cap companies, not growth companies anymore. But I hope we, from NASDAQ point of view, provide a great infrastructure. At least you're trading on the same system, using the same technology as we do in US and in Sweden. So it's hopefully not the infrastructure on our part, NASDAQ's part, but I get it. Some of the banks need to have custody setups towards the Baltic countries, and that takes time. But if there are a couple of good cases, I hope that will help. So if there's one thing I would love, one or two companies more like Ignitis, and I think that will help a lot.
Thank you. And now I would like to invite questions from the audience. Yes, please. I see the first hand. The mic is coming. Yeah.
Good afternoon. Lina Vatėnaitė, European Commission Asset Management Unit. I would like actually, first of all, to thank everyone. It's such an interesting discussion. I came in with a set of questions, which basically I got some answers to already. So it's very, very interesting. So I had to change the list of questions I would like to ask the learned panelists. But first of all, if you permit, I would like to ask to provide a few remarks, because I think these are in good order. I've noticed a recurrent theme, and also the learned panelists also espoused, where that the single market is somewhat wobbly, not complete, perhaps not functioning well. But I think most of us, if we tried to open a brokerage account in another member state, it would take us 2 hours, and you would get access to any kind of investment product you fancy, and you would invest, like, I don't know, 2 minutes. So in a way, I think that since there was a theme that perhaps single market is not really working, I think for a retail investor or anyone investing, it's not really particularly accurate statement. Now, as to the slowness of completing capital markets union. One point to make, as we are now in the process of, let's say, completing the reforms or plugging in the regulatory holes, one important aspect is the time frame under which we are now operating. An example, AFMD LTIF review, 6 months in the council to agree among all the member states' opposition. This is super, super short. Money market fund reform took 10 years. Imagine, so 6 months, just to give you a perspective, we're moving very fast on this. So now I'm coming to the question, and contribute to the discussion. So now, going back to the theme, access to finance. As was mentioned by the aligned panelists, that this region is perhaps a bit more centered, a bit more tilted to the banking opportunities. But now, could the investment funds, crowdfunding platforms plug in the gap and help the SMEs to access finance in addition to the banking financing? So I'll conclude here. Thank you.
Thank you. Maybe Gedimina, you would like to reflect?
Well, my answer is definitely yes, and I think this is what's happening. The issue is that the companies that need finance or need to unlock the finance, they need it now. Not in a year, not in 10 years, until the sufficient scope will be achieved. And then we do have a question of or a problem of chicken and egg. Who's first? Should we wait until and hope that these crowdfunding platforms, alternative credit providers, they will grow? Yes, I think it's and the issue of non-bank finance or non-bank intermediation or non-bank credit providers. It's so-called shadow banking. Even if I don't like the word shadow in this term, it's very, so to say, it's very. The question is known, but in all this perspective where you raise the question, also we see the merits of the capital markets and development of it as well, because for companies to grow, especially those who focus the activities on the credit provisions, they need capital. Otherwise, they will grow only to the extent the profit accumulation allows, and it will take decades. So what capital market in development of it and access to financing there does, so it allows for those financial market participants, also financial market participants, to raise the capital, to raise the equity, and then to provide or to unlock access to finance for small and medium enterprises and ordinary companies even faster.
Maybe I could just build on what the governor said. Yeah, I think I would also take it broader, right? The credit funds, crowdfunding, public funds. But one of the, I think, a good example, we don't need to look far afield. I mean, if we look at the private equity funds, and the development of these funds in this region has been rapid. One of the probably key component, to my mind, would change is actually supranationals, EIB coming in, at European level, setting up programs where they actually, seeded these funds. Look at what is happening today. They are private, they're raising their own money, they're investing, they have a lot of dry powder, and that's actually, I think, one example that's not, from Sweden, is here from the region, right? So it is, again, another playbook which could be probably used in other areas to spur the development of alternative capital providers.
Thank you. Do we have more questions from the audience, please? Doesn't seem so. Well, I think we had an excellent conversation, and lots of ideas will touch all of the aspects: demand and supply, and retail investors, and institutional investors, and local and foreign. And I think that's a very good momentum, especially for this country, because we are starting to work on a capital markets development plan, newly adopted, and these are all the ideas which we have to implement, and I'm sure they will be taken on board by the people who operate that. I want to thank the panel members very much for joining and for this conversation, and thank you for the audience.
Thank you very much. Thanks for a very, very brief wrap-up, some takeaways. Extraordinarily good shape. These are the words to describe a specific, exceptionally good situation of the financial sector in the Baltics. The financial systems are more robust than during previous turbulent times. Capital market union, moving too slow. Some companies, SME companies, are not helped as much as they should be. Some countries have better ideas and work faster than capital market union could. Retail investors are needed, but there are enough in the Baltic states. It's the institutional ones that are missing. A Swedish playbook might not necessarily be an answer to everything. Invest in local equity and build on that. Without a good institutional investors base, it may be hard to provide constant liquidity for the markets. Cultural resistance of letting the control all out of my hands. But there is a generational shift that is happening. That's good news. For the bonds, it's okay. For equity, the ease of trading should be fixed for the international institutional investors, and some other issues should be solved too. It will take some time to develop that, and there's lunch in the restaurant on level 1. Let us come back here at 1:30. Thank you so much.
I would say that some of our topics were already touched or hijacked by some other panels, but I'm still convinced that we need to drill into a bit deeper waters here. So please join me in welcoming panelists to our third panel. Vaida Markevičienė, Vice Minister of the Ministry of Finance of the Republic of Lithuania. Arminta Saladžienė, Vice President, Head of Post-Trade European Markets at NASDAQ. Andres Suimets, Head of Private Banking and Wealth Management at Swedbank Estonia. And Mindaugas Valiulis, Capital Markets Union Unit at European Commission. Before we start the discussion, before we start the panel, I would invite Mindaugas to the stage and make us a short presentation. This initiative coming from the European Commission was already mentioned a couple of times during this day. So it's about retail investment strategy. So Mindaugas, you're welcome to make a short presentation about it, and then we'll jump into discussion.
Good afternoon, everyone. So my name is Mindaugas Valiulis. I am a policy officer in DG FISMA, which is the Directorate General within the European Commission responsible for financial services, financial stability, capital markets union. The presentation I'm going to give to you today is going to try to give you a bit of introduction, a bit of background on the upcoming retail investment strategy, which is currently being prepared by the Commission and will be published in the coming months. This presentation is supposed to set the scene for the panel discussion on connecting businesses and savers. So with this, I wanted to mention that the idea of trying to find better ways to connect businesses and savers has been at the very heart of EU policy making for the last years. In 2015, we came out with the first CMU action plan, which was later complemented with the CMU midterm review in 2017. These action plans together had over 60 specific legislative and non-legislative measures that sought to create new European products, labels, and passports. We tried to introduce clear rules for businesses and investors, as well as to ensure more efficient supervision of EU capital markets, and in particular in a cross-border setting. In 2020, we took stock of where we are in the process and came out with additional 16 further measures to keep pushing in that direction. The three key objectives of the new action plan in 2020 were to make capital market financing more accessible, to make the EU an even safer place for individuals to save and invest long term, and to take those two together and integrate national capital markets into a genuine single market. On top of that, as under each objective we had specific measures, we announced that in the coming years we will be coming out with a dedicated retail investment strategy. Now, why did we announce an additional strategy on top of what we were already doing? It's because that we see that Europe is really lagging behind on this element. So we see that Europe has one of the highest saving rates in the world. However, the level of retail investor participation in capital markets remains extremely low compared to other economies. Some data that I've looked at on Eurostat show that only a quarter of EU households actually directly engage with capital markets, and that only 17% of EU27 household assets are held in financial instruments. Meanwhile, that figure is around 43% for the US. So there's a big gap there that we need to fill. Another more important reason, and I think the most important in fact, is that our consumers in Europe are increasingly pressed with issues that efficient and effective capital markets could provide a viable solution for. We see that the EU population is aging, life expectancy is increasing, and that's putting an increasing strain on our public pension systems. So it's becoming more and more evident that individuals need to have complementary sources of retirement income in order to have an adequate pension, which they could get from individual savings and long-term investments in capital markets. We've also seeing, as many today have already mentioned, that this huge chunk of retail savings and deposits are simply being eroded over time by inflation rather than growing. And we also see that sometimes, even in cases where individuals do choose to invest in capital markets, they receive suboptimal returns on their investments because the investments they made were not appropriate or the fees were too high. So why do consumers refrain from investing? There's a variety of reasons, including very valid reasons such as not having the savings to invest. However, amongst the addressable issues, we see that a lack of trust in capital markets and the perceived complexity and costliness and non-transparency of the whole process are major contributors to that issue. And we're analyzing now the current regulatory framework, and we're leaning towards a conclusion that the current framework is not ensuring optimal outcomes for consumers. So in the retail investment strategy, we'll be looking at a variety of different topics along the investor's journey. It's going to be a very comprehensive package. I can mention some themes that we're looking at. So it's going to look at, for example, marketing roles and the role of social media, in particular, the growing role that social influencers have on individuals' investment-making decisions. We'll be looking at information disclosures, whether they are adapted to the digital environment, and whether they make sense in general, whether consumers can understand them and engage with them. We'll be looking at conflicts of interest and the quality of advice. We'll be looking at the rules around suitability and appropriateness assessments, whether they are indeed fit for purpose. We'll be looking at investor categorization and qualification of advisors, cross-border supervisory enforcement, also value for money of investment products. And we'll also be analyzing potential measures to contribute to member states' efforts to increase financial literacy. Now, the Commission has been working on this for the last couple of years. We've been conducting a lot of preparatory work. Among these are a major study that we commissioned on retail investment that analyzes the distribution systems, and in particular, the rules on disclosures, inducements, and suitability. We received 3 detailed reports from the European supervisory authorities that analyze a number of these issues in depth as well and provide us with some evidence. We've conducted a very in-depth public consultation on a wide range of these issues, and we also organized a range of targeted workshops, consultations, as well as bilateral discussions with stakeholders. The guiding principles that we are using for the retail investment strategy are the following. So we want consumers to be able to access transparent, comparable, and understandable product information. We want that when consumers go to a financial intermediary, they are treated fairly and that they receive bias-free advice that is in their own best interest. We want our capital markets to be open and competitive and to offer our retail investors cost-efficient products, and that our retail investors are adequately protected in all situations. So to sum up in a few words, we will be coming out with a retail investment strategy in the coming months. The main objective will be to put the needs of ordinary investors at the heart of EU policymaking, at the heart of the EU financial system, and thereby enable improved outcomes for all 450 million residents within the EU. And we hope that as a consequence, we will be increasing the trust, we will be increasing the level of retail investor participation, and thereby bringing us one step closer to completing the Capital Markets Union. Thank you.
Thank you, Mindaugai. Please join our panel. There's one more slide that I wanted to show before we start discussion. Mindaugas have touched retail investment strategy. Obviously, we'll get into some depth during our discussion. But before we start, yes, thank you. Before we start, I wanted to show where are we right now. Where is Lithuania, Latvia, Estonia in comparison to Scandinavian countries, Western Europe. This slide shows households' investments into investment funds and listed shares compared to cash and deposit. One thing is very important to mention here. Seems that in 2021 there was when there was a reform in second pension pillar in Estonia. Something has happened with statistics, and I couldn't get all those details in such a short time frame. So to make sure that we have a more realistic number, so you can see that there is an asterisk for Estonia below the chart. So Estonia is somewhere around 12.5%, was 12.5% in 2020. Obviously there is some growth, but the number should be very similar to this one. So you can clearly see that Baltic countries are significantly behind well-developed capital markets, and obviously we need to do something about it. And such a lag, I would say, first of all, forces me to ask a question about how come we are so different. And here I would like to turn to Arminta, first of all to you. You own infrastructure. You do have the exchanges in all the our markets, in other markets as well. Can you say how our infrastructure looks in comparison to other markets? Do we miss something? How come we are so different?
Thank you, Vytautas, and good afternoon to everyone. Before I get back to your question, I just would like to start maybe with a note so that we understand the benchmark we compare ourselves to. The Nordic markets are best in class Europe-wide, and especially when it comes to SME access to funding or retail investment opportunities. On some measurements, like for example, historical stock market returns or level of financial literacy of the general population, they top the global ranks. So this is, of course, both an inspiring but also an ambitious benchmark. And as you alluded to our regional role, we have other regional players. I think the Baltic markets are very fortunate to be in this proximity, and we should definitely benefit from that. Now, back to your question about the infrastructure. I think it would be fair to say that the Baltic markets are at par with the Nordic peers when it comes to the basic pillars of the market, and especially on the infrastructure angle. As the market operator, not only do we use the same platforms or technology, we actually, all the markets run on one single same trading platform that the intermediaries members can access. On one aspect, actually, the Baltic markets are even more advanced. And this is the single regional central securities depository that we operate. And we can see that the cross-border flows within the region are even more seamless compared to other parts of Europe.
Thank you. And Andres, I would like to turn to you as you are representing one of intermediaries. So obviously the question, how do you see the situation when it comes to access to different markets, when it comes to access to products, etc.? Could you please comment?
Yeah, thank you. Hi, everyone. First of all, on the numbers on Estonia, it's not that high, but it's around 20-25%. So indeed, Estonia has had a quick growth when it comes to investment and the proportion of that, not 50%, quite not on that level yet, unfortunately. But I would say that now, if we think about the participation of retail investors, then it's not really the case of us missing something on the infrastructure side. Clearly, it's not the case. The growth, and maybe we'll go into that later, in Estonia, in the number of retail investors, in 5 years, it's grown from 20,000 that have invested into local listed shares to 100,000, but the infrastructure has been the same, right? So it's not the infrastructure, it's the companies, it's the IPOs, it's the awareness, it's the literacy. So we will get into that, I think. But to answer the question, no, today, I think it's never been easier to open an account, to invest globally, whether it's funds, ETFs, local stocks. There's no fees in some cases. You can do this on mobile. And in the Baltics, it started much earlier than even in Scandinavia in some cases. So to give you Swedbank as an example, when I joined in 2006, you could trade 20 markets online. In Sweden at that time, it was just Sweden and maybe Scandinavia. Today they have US as well, while we've had 20, 25 markets all the time. So in the palm of your hand, whether with your mobile app, you can trade any market. There's plenty of products there. The pricing is quite competitive. It's never been cheaper. So I would definitely say if we are not happy with the retail kind of part within local markets, then it's not due to infrastructure or the offering, it's rather the awareness of investors.
Okay, yeah,
if I may build on Andres' comment, and I think what we can also see from the Nordic markets, but that the awareness and the way majority actually of new investors get into the world of investing starts with the local market. And here, of course, the differences and the gaps are quite conspicuous. We heard from the panel before lunch that in Sweden, 1/3 of the population have direct holdings in shares. In Finland and Denmark, it's roughly 1/5, 1/4 of the population. These are high numbers. And then if we add, of course, the investment, indirect investment via mutual funds, via other collective investment instruments, we go to really, really high numbers. And this is absolutely a key pillar for the vibrant ecosystem of the Nordic markets, that they have a great mix of investors, domestic and international, institutional and retail.
Thank you. So at this point, I would like to nail that we have everything what we need in place when it comes to retail clients. We can definitely go into different derivatives, some complicated products, etc. But in principle, when we speak about retail investments, when we speak about mass segment, it seems that we have everything in place, what I just heard, right? Okay, good. And now I would like to turn to public authorities topic. Keeping in mind how big the gap we have, keeping in mind that we're constantly every year, I don't know for how many years we're speaking about that there is such a need for development, that capital markets are so important, etc. So Vaida, would you please comment on the question how public authorities are facilitating the change? What is being done? Maybe something is already planned, already in progress?
So I think a lot of people who came here probably had one question: will there be an investment account? But I want to emphasize that probably there is no such thing as a silver bullet, and even the investment account that the Minister of Finance already covered in the morning, it won't solve all the problems. So of course it will make things easier, it could make things easier, but way more actions are needed. And we are working on the 4 interrelated blocks. So of course, now you all heard about the capital market development guidelines that were prepared together with the Bank of Lithuania and the Ministry of Finance. And we have the council that is composed of authorities and private sector participants from different areas that will do many small steps that will move us a big leap forward, I hope. And we also are developing Green Finance Action Plan. And Green Finance Action Plan will we know that for the green transition we need a lot of funds, and public funding will never be enough, and businesses will have to accumulate way more funding from private sector, from traditional financial intermediaries, but also from the capital markets. And having green investment opportunities, I think, would also attract more investors. On one hand, for people who want to invest in something they believe based on their values, such as saving the climate from a huge catastrophe, but also they can also act as catalyst and increase the demand, and this way encourage companies to issue more green bonds, let's say. Another aspect that we are working on is fintech guidelines for upcoming 5 years, and the document covers way more aspects, but one of the aspects and guidelines is encouragement to attract different source of fintechs in Lithuania, and in Lithuania we have a lot of payment providers, e-money institutions, but a bit less of such institutions as those that are providing wealth tech services. So we also made a survey, and of course people are very aware of financial intermediary, digital banking, and that's their primary thing. Then they go to fintechs, but also, for example, crowdfunding is very popular. And I would say, crowdfunding has similarities to the capital market, and here we managed to make a huge progress. So in 2017, we had just 7,000 people investing through these platforms, and this year we have around 50,000. So the increase in the growth is really massive. So the interest is there, and the potential is there. And also we understand that the infrastructure, as you say, it is here, but probably it doesn't harm to have more of it. And people are used to accessing services in a very simple way, as you see on their mobile phone. And when we asked if they would like to try wealth tech services that are provided by fintech, almost, I would say, 40 or 50% of retail said that they would be willing to try that out if there would be some fintechs offering these services. And around 20% of SMEs said that they would be willing to use these platforms. So it's also, there is still a potential there, and I think the more supply we had, then the more people would start using them. And I think the very backbone, and probably this will be repeating what people in the previous panels were saying, financial literacy. It is the key. And not only to make people understand that it's beneficial to kind of invest their savings in the capital markets, but also understanding the risks. And probably here everyone is like advocating the capital markets and investing, but people have to also understand that it does come with certain risks, and they have to understand what they are doing then they are in the market. So it's not only about the kind of financial market fluctuation risks, but also to be immune from scam schemes and so on. So financial literacy has to go hand in hand with all the development, and we are preparing the plan, as was already mentioned in the first panel, that would address schools, that would address general society, and also small and medium-sized enterprises.
Okay. Quite a big elephant, I would say. So we'll try to chop it into pieces and come back into some of those topics that you covered, because those are really interesting and very important. But just before that, as you've touched on Lithuanian part of it, I would also like to turn to Mindaugas, to you. On European level, you've made the presentation about retail investment strategy. That was a high level, just showing the transparency, what are important guidelines, etc. Could you please try to elaborate a bit, be more specific, closer to the down to earth? I mean, how would that exactly potentially help to our retail investors be dragged into the market, start participate there? Yes, we can hear you.
Hello?
Yep.
Yeah. Okay. Sorry for that. Yes. So I don't know if there's that much more I can add or elaborate on as to what I said in the presentation, because I mean, it's a bit difficult to talk about specific effects of something that's not there yet, that we know, where we don't know exactly what we're going to be doing. But I would just stress that, I mean, this has been a very important topic for us at the European level, and we've been working on this since 2015 through very different actions, because I think here the issue is that, well, there is no one single issue. There are many different issues that need to be addressed. It's a complex project, let's say, to try to fix and improve capital markets, to make them more efficient and to attract retail investors to invest. For specifics, maybe I could mention a few examples of the current CMU action plan. So, for example, one of the actions we're undertaking on withholding tax is going to explore ways. Well, we're currently exploring ways to introduce a standardized EU system for withholding tax relief that should make, well, incrementally easier for investors to engage with capital markets in a cross-border setting because they can more easily retrieve the taxes that are being withheld, and that makes it more lucrative for them to invest. Something that was mentioned earlier today on the European single access point, I just wanted to add that, in fact, the European single access point for company data is actually also going to include a database for all the PRIPS key information documents that are being produced by product manufacturers. And maybe just one final remark with the retail investment strategy. As I said, the main idea is that we want to do many changes to fix all the small things that are potentially not working with the current system. With the current investor protection framework, we want to optimize it, ensuring there's minimal burden, let's say, on companies, whilst giving maximum benefit to investors. And we hope that by making the system more efficient and more beneficial for the investors, we'll be increasing the participation of retail.
If I may reflect very shortly, what I do see, what I do feel is that we're improving already existing system, right? So we are in principle working about those 50, 70 or 100,000 clients that we have, while we have a huge lag when we compare ourselves to Scandinavia or Western well-developed capital markets. So that kind of pushes me to think that we have to do something different, we have to do something faster, I don't know, stronger, bigger, it has to be something. And if we come back just shortly to the slide that we had previously, where Estonia had completely, or let's say in comparison to Lithuania and Latvia, Estonia looked very much different. So Andres, could you please share Estonian success story? What was there? What has happened?
I guess it's work in progress, I would say, more so, but we need to go back quite a bit. I also had one slide in mind when speaking. We have been tracking the number of investors that have invested locally through the CST, then we can get this data. In 2018, we had 2 IPOs in the pipeline, and the kind of the narrative in Estonia was always that to get investors, to get retail investors, you need to have IPOs, and to execute IPOs, you need to have investors. So that was the narrative for a long time. And then we had the decision of good quality IPOs coming to the market in 2018. The number of accounts, the number of investors that are active locally was around 20,000. And that's when we had Port of Tallinn IPO in place. After the IPO, the number grew to 27,000. And that we felt was an achievement. That we felt that was an excellent result. It was a little bit below Tallink IPO, but still a great result. From then on, it grew steadily. We had different IPOs in the market until we ended up in a few years ago in a situation where it reached almost 60,000 locally. And the reasons behind it, I think it's interesting to digest in the sense that it's multitude of things that need to happen locally for retail investors. One is indeed the offerings. Well, they feel that they trust the issuer, they trust the company, and they feel that they will receive a return if they participate in the transaction, in the IPO. The second is the investor education. And the lesson there we've had is clearly that you need to simplify. And maybe we get into the platform part of this as well, is that whether it's the environment you use to invest, and that's why the fintech part is not so successful, it needs to be simpler, really, for the investors to use it. And then the second part is the investor education. You need to be able to explain it easily and to get investors to the point where they can take a few steps and understand how to start. The third part of all of it was the community, really, that you can have bank experts, you can have the offerings, but you need to create a community for the investors to really interact when it comes to investment ideas, what mistakes not to make. So that's a really practical part that really took off in Estonia, I felt like. We had different communities. We had spokespeople outside of the financial markets area, maybe somebody that had created their own portfolio and grew it successfully. So they were the ones that were showing the way, essentially, for everybody else. Now then we got to the Enefit Green IPO, which was kind of waited for many years. And where at the end of the day, I think it was the perfect timing of very much risk-on appetite in the markets. The retail investor base had grown quite a bit, and went it with 60,000 investors, which, if you think about it, it's 4% of the population. I'm not sure it's a record in that sense, but it's close to those levels, that high percentage of the market participates. And the answer then in that sense is that yes, you need to have investor education. You need to simplify the product offering. So when the client does open the interface and wants to invest, it needs to be simple enough for them to be able to do so. They don't need the training to buy stocks. And also pricing, I would say that the prices have come down. You don't have that barrier if you want to invest. Indeed, if you start with local stocks, since it's free of charge. You look for the local exchange, you know the companies, you maybe kind of understand the business case a little bit better, and then you also need to have the IPOs to really boost the growth of local investor base.
Okay, thank you. As investment account was mentioned, I believe today in both panels before, and Vaida also mentioned it, just a question when it comes to Estonia, as Estonia has already investment account for several years. Did it help? I mean, what can you reflect on that a bit?
Yeah, to me, it's when we recommend somebody to start investing, the investment account is the basics of it, right? So if you're not investing through a company, you always use the investment account. When it's time to do your taxes, it's pretty much automated, so it takes you a minute, right? So it's to me, it's like hygiene kind of a thing, right? It will not solve anything on its own, but if you don't have it, it's very difficult to move ahead.
Okay, and Arminta, I would like to turn to you regarding the investment account. As you are present in different markets, you've seen different examples, etc. And Bjorn, by the way, also mentioned investment account in different geographies. Could you share your thoughts on that? I mean, on the history.
Happy to. And I would probably make 2 points in relation to the investment account. The first one is, just as Andres said, it matters. And it's part of the hygiene. So whenever we look at, like the offering or capital markets ecosystem, for example, the index providers, MSCI, FTSE, they have like a checklist, in terms of hygiene, what kind of components you have in the market. So this is part of the hygiene for the retail offering. And we are the last market in the region not to have one. So I think it's also a bit a matter of pride, not only to fill the gap, but do better, right? So yes, I think we heard from Bjorn Sibben earlier today that Sweden leads, but it's also because they were the first ones with their ISK investment savings account, introducing it in 2012, now nearly 3.5 million. On population of 10.9, I think. So it's pretty impressive. We can turn to a more recent example of Finland, which introduced their equity savings account. So they limited the scope to only equities in 2020, in January 2020. And it's also quite interesting to observe the traction. For the past decade in Finland, the number of households owning shares was very stable. It was 800,000, individuals, flat. And with the introduction of the equities savings account, 300,000 accounts were opened in a matter of 2 years. And that actually fueled the number of investors now just passing 1 million. So it absolutely had an effect. Now, the second point I would like to make is that the design of the account matters. And that, again, we can witness looking at the different examples. So we can turn to Denmark. Again, Bjorn briefly mentioned that, being Danish, that Denmark had a very good ambition to replicate the setup in Sweden, which is actually broad-based, extremely simple, standardized tax, automatic, reporting, and all the other nice features of this account that make it attractive. But it was hijacked by the politicians in the parliament in the trade-offs battle. We will approve this if you reduce an excise on sugar. We will be okay with that, but if you do something for the meat, industry. As a result, the outcome was pretty poor. So now Denmark has an investment account, but it would be hard to believe what cap they put in terms of the value in the account that you can have. So the initial cap was 6,700 euros, the value of your investments that could be in the account in Denmark. Now it's something just over 13,000 euros. It's pennies, right? Even in European in Baltic terms.
Is it per year?
No, it's the total value on
Overall
which you
portfolio.
can, on which you can apply the account. So that's one thing. The other thing, what they did differently from all the other examples, you will have to pay a tax. It's going to be a bit lower tax, 17%, on unrealized gains in your account. Again, raising eyebrows, exactly. So we have these, this is a vivid example. And then again, if we flip to Finland, for example, so they actually use the right features, where you can cover your losses with capital gains. You can, postpone your income tax liability until you start withdrawing your, gains, and then you make this account as a mini mutual fund. Where dividends and capital gains are only taxed when they are, taken out of the account. So I really hope that the process in Lithuania will not turn into the same as in Denmark, and the investment account will not become a hostage of the other issues we want to address in the tax system.
Okay. So in principle, if I get it right, looking back into the history of Estonian story, when investment account was introduced, I mean, it was more of a hygiene factor, and it did not create any huge, fantastic results in attracting investors, etc. So basically, in principle, if we sum it up here at this point of time, if we have something similar as Estonians do have, most probably it's not going to change. It's not going to be a game changer. So then the question, Vaida, could we expect maybe that we would be working around and doing something better than others, than neighbors? If we are the last one, maybe can be the best one.
So probably I won't go into the details of the investment account for the very reasons that actually Arminta mentioned that we want to avoid. Why the tax reform goes as a package, because we don't want it to become, trade something for sugar, whatever else you were mentioning before. So the investment account is in the package, and it was discussed with in the working group of the taxes. There were broad participants of the private sector, public sector economists that were involved, but of course it can't go on itself. If we want to move forward with that, we have to understand that we have to get rid of some other exemptions that we have in our system, because otherwise it will soon become the rule to have an exemption, and the rules itself will become something of a rarity.
Okay.
Maybe I'll just briefly explain how it is in Estonia, just so, because it's a lot of different setups, but it's essentially a cash account that's connected to your securities account, and when you take more money in, then you put when you take more money out than you put in, then you pay the tax. There's no limits to that, right? So there's no 6,000 euros cap or something like that.
There's a limit. It depends on how much you put in.
Yeah, that's the only one.
And this automatic reporting that you mentioned, Arja, is absolutely key, that it has to be extremely simple, and banks really, or intermediaries, so brokers as well, play a very important role here in making it a good experience for the retail investor.
Yeah, so there's no trade-by-trade reporting as you would have otherwise. There's just the net amount of cash, essentially.
Okay, thank you. And there's another buzzword, financial literacy. We've been hearing it, I don't know, for years, and as well in today's other panels. Every year, I believe there are several surveys performed, and then results are announced that when retail investors, when households and private individuals are being asked what do they lack, why they don't invest, usually the answer, we don't have information, we don't understand, we lack information, etc. Something like that all the time or very close to that. Also, Vaida, you mentioned financial literacy. So could you just maybe elaborate on here what is going to happen? Do you see some clear initiatives here? What's going to be different? Because we really need a change.
So probably what is going to be different that now we are forming an ecosystem. We have a group composed of private sector, public sector, also educational institutions that are going to decide on the KPIs that we want to achieve with financial literacy in the three sectors and have concrete steps to change them. We already started working also with the programs at school so that it will be taught from the early age. And for small and medium-sized enterprises, we clearly see the issues. There was a survey made that if the company gets no from one institution, they just don't go to the other. So I would say if just the question is what will be different, so I think now the commitment is clear and we do it in a more kind of strategic way to have goals, to have concrete actions, to review regularly if we are moving forward to address these goals. Like it's a bit too early to talk about the specific actions that we are going to make. I don't want to jump in front of the working group that we composed. It has to be a democratic process so that everyone will do their part, because the government on their own, we can't achieve significant results. Everyone has to contribute and do their bit.
Agree.
On this, I might add, on the topic of adding our bit for financial literacy, that the Commission has been working on 2 work streams on this in cooperation with the OECD. And this was about developing competency frameworks for adults, which we published last year. And we're working now on a financial literacy competency framework for kids and young adults, which will be coming out with the summer. And we hope that it will be useful for member states to take some inspiration for the work that you're doing.
You wanted to reflect?
Yeah, I wanted to add a little bit that, of course, when we talk about financial literacy, we do not expect that everyone will be like a qualified financial analyst, being able to work through all the documents that, for example, are presented when the IPO is made or something like that. So, of course, it's like the basic skills, but there is also then some work to be done by...
Yeah, correct. I think individuals need to be able to ask the right questions when they go to a financial intermediary. They need to understand what they're looking at, basically, what kind of products are being offered to them. I think that's the key issue.
If I may comment here, from how do I see it, what you are saying, I mean, is very right path, right? How to proceed, what to do, to have strategic view, etc. But that's evolutionary way. I mean, if we look back to Scandinavia, Western European countries, then it means that I will grow old and bold until I see some my kids being at good level, or my grandkids if I am alive. So the question: can we make something faster? I mean, is anyone willing to propose any spice particular to this recipe? Can we make it faster? Can we make it, I know, bigger? Anyone?
Yeah, I think the answer is in your question, Vytautas.
Have to grow old?
No. We have to find scale, right? I mean, we need to scale and fast. So the first answer to this is use technology, right? Sure, we will not reach everyone, because I think there is another important aspect in the topic of financial literacy, and that of financial inclusion. We have age, gender, income, digital skills gap, in the financial literacy, so which needs to be addressed, and probably more senior citizens without, proper digital skills, they need to be reached in a different way. But for the massive and younger population, I think technology is the answer. So if we have the right applications, webinars, programs, and actually approach it in the way how people consume other content, right? Like this is how we all consume content in the palm of our, in our palms. So that would be one. The other thing, I'm also a believer of collaboration and leveraging what we have, because if we start from scratch, then it's absolutely, we grow all old until we see any impact. But let's look at Junior Achievement. They are doing fantastic job in youth economic and financial education. Fantastic. So why don't we look at how we help them scale and get into all schools in Lithuania, no matter how far from the city centers they are. So these would be my examples.
I wanted to reflect, but if you can please very shortly, because time is really pushing us.
So I will. I want to agree with Arminta, and I want to be more optimistic with your from what you said. So maybe you won't grow old. About your health, and you growing old. I will repeat what I said before. We had very new product crowdfunding in 2017. We had 7,000 investors, which is already, I would say, it's not a little number. Having in mind that it is something very new, like very new in general, and Lithuania was one of the first to start that. So in 2020 we have 50,000 investors. I think it's not evolution; it's rather a revolution. So this is an example how technology can make this leap.
Just quickly, kind of a practical example from my side. I think exactly as you said, the technology is solving this for us in a way. When we tried to create an investment school in Estonia, it was always limited to the number of people you can fit into the room. When we did this in 2021, and in that time the interest was indeed quite high, we did a few seminars that reached over 100,000 people, right? And the aim was how to start invest. And the first part is, of course, why to invest at all. You need to explain that. They need to believe that. And then how to do, and the first actual steps to you becoming a shareholder or an investor in a fund, whatever it might be. And so I think the fact that you can reach now across the country digitally, the only thing you have to keep in mind is that it has to be compact, it has to be easy to understand, and so on.
Thank you. Maybe I could add another angle here about the products, because maybe we could have some I don't know, intermediate product just before the MiFID, so that we could speak freely, so that we could invite all the clients and just make sure that the education and the word spreads out. I would say yields are back, right? So at some point of time in history, Vaida, we used to have government saving notes. Maybe we should reboot the system and just take the dust away and restart.
I see that we don't have much time, but I have heard this question a lot, so I will try to elaborate a little bit more about it. So basically, yes, we did have this product, but we discontinued it in the last years because it wasn't, at that situation, it was not effective or useful anymore. We had very little people investing into that because of the rates, and the costs, the commission costs were rather high. But of course now the situation is different, and we can always go back into the products that are useful. But from the state's perspective, of course, we have to balance things. So we have to have an alternative to savings that are useful for those retail investors. We also don't want to distort the market. We don't want to pay more for those in that sort of borrowing, because the money that are borrowed by the state are used to fund the same services that the state provides. So when we balance all these matters, at some point it was not beneficial anymore, but of course now the situation changes and we have to reconsider if it could be potentially useful again.
Very shortly, please.
Yeah, I think connecting this to also the Nordic markets, where we certainly have a gap, is the breadth and depth of the local tradable and non-tradable investable instruments that retail investors could access. So I think anything that can be done in providing more products that would be accessible to retail, of course, balancing, this knowledge and, investor protection side is welcome. And Latvian Treasury has just restarted savings notes. So I think in January alone, 12 million euros were borrowed this way from Latvian just private individuals.
Last question from my side, Mindaugai. When it comes to European Commission and higher understanding from high level, if we look at products, would that be? I mean, if we try to speculate, would that be possible in principle to look at product side that we have something safer, intermediate, so that there is a way easier process to approach clients, to educate, to show something? Because education at school, I mean, it takes time. Speaking about, just marketing, it takes time. I mean, it's boring. They need something tangible. They need something real, material. Can we speculate a bit on that? Would that be in principle possible, just some direction to look?
In general, I mean, as I set out on the main guidelines for what we're looking at risk, I mean, I wouldn't identify this as a main topic, as a main theme within the retail investment strategy. But I take your point that it's a valid concern that you need to be able to access the investor base, and we need to reflect on all possibilities, basically.
Thank you. Our time is up, but I hope I will stretch to 2 more questions from the audience. Do you have questions? Hands? Okay, organizers will be happy. Then, if I may ask you, but please be precise, everyone, 30 seconds, what you wish for the market, what you wish for Baltics, for capital markets development.
Yeah, so we have financial literacy so that everyone would understand the value to invest in the market, the use of it. We have fintech that makes it easy and very user-friendly. We developed green finance action plans, so we will have products that would not only be financially beneficial, but also doing something good to humanity. So there will be, I think, very good base for investment. And having said about the investments that are easy to understand, easy to make, and based on universal human values, I would like to encourage everyone to invest into buying radars for Ukraine. So don't forget to invest into the future.
Okay, Andres?
I would say it's all about creating retail demand. We know the funds are there, so they are there to be invested. If you do create the demand from the retail side, you can get institutional investors in the Baltics as well. To do so, to create the demand, you need to be able to show that investing is not that complicated, really. So you need to have the investment schools, you need to simplify and also build products that are simple to use. So that's it.
In addition to Ignitis, Enefit Green, Port of Tallinn, 8 more companies of this caliber on the Baltic market. With this, our index classification will be upgraded right away. The issues that Jonas Rimkevičius from Ignitis talked about international institutional investors not really being willing to connect, will be resolved. They will rush for this market. So that would be the number one thing. And then getting local investment account with the right design, proving that we can prioritize this.
Okay, Mindaugai?
From my side, I would maybe say, well, for the Baltics, I would encourage the Baltics as very small, yet very ambitious and very forward-looking countries to try to be a bit louder at the EU policymaking scene in voicing your views, voicing what you think is best, because I think you have some good ideas and those could possibly be inspiring also at a European level.
So thank you very much and for the conversation, for discussion. I hope that it was interesting. So thank you, the panelists.
Thank you.
Thank you so much. Thank you for your interesting discussion. I just want to emphasize that neither the organizers nor the moderators are ever happy when audience does not raise any questions. So do get your questions ready for the next panel, because we still have the next one to come. They are happy because the more questions you ask, the more instrumental every conference, every event, every discussion is, and then we can make most of it, each of us. But yes, it's true, we are lagging a bit behind. So thank you for this discussion. As you put it, it was more in-depth, it was a more technical one of the issues that have been discussed throughout the previous panels. Financial literacy was something mentioned many times by nearly all the speakers that spoke here today. And can we move faster was the question that was raised. And one of the key answers to that, presented by Arminta, was technology. Technology is the answer, she said. And it is technology we will be discussing next. Cutting edge tech trends in the capital markets is the topic of the final panel discussion. And please welcome the moderator of the discussion, co-founder and partner at law firm Wallace, Ms. Joanna Boblide Kulviete. Let's welcome her here.
Everyone to the fourth panel of today. There are not so many people left, but I hope that others are watching us online using the technology. So in the fourth panel, we will discuss the tech trends. We will discuss how technology can help solve the issues that we've discovered and discussed today. And also we'll share insights as to how technology will shape development of the capital markets going forward. And I'm already convinced that it will be way different when we see it today. So let me welcome my fellow panelists. And first of all, Rolandas Jutejka, head of Revolut Securities. Revolut is pretty much well-known brand, so perhaps no need to say more. Jeff Pascella, global head of business development at DryWealth. DryWealth is a US firm fueling the future of embedded finance. Vytautas Plunkstis, founder and chairman of the board of the Investors Association. And Jan Lorang, head of global digital assets at Nuvei. Nuvei is a global payments technology company, also focusing on digital assets. So to start our panel discussion, I would like to first of all invite Rolandas to give us a presentation on the current tech trends and perhaps the opportunities that technology brings to us. So Rolandas, the floor is yours.
Hi everybody. So tech trends shaping retail investments. Before we dive into the topic, I still have to do this. So about Revolut, just a couple of sentences. So Revolut was founded in 2015. This year we'll celebrate 8 years. The main numbers at the moment is we reached 25 million clients across the globe. We are live in more than 50 countries, and actually there is no point where Revolut might stop and say that we are happy about our achievements. So we are trying to always never settle, to always make our products better than our competitors. And our vision and mission is to create a super financial app, where you will find all the products, including investing. So tech trends shaping retail investments. So my goal is to show you the main trends that are shaping investments at the moment. Maybe these are not at the moment visible in many places, but I think that soon we will see more of those. The first, which is one of the most interesting is artificial intelligence, robo-advice, blockchain, digital platforms, and overall mobile platforms, and virtual and augmented reality. So let's start from artificial intelligence. And now my question is, are there any people in this audience who didn't hear about ChatGPT tool? Okay, 99.9% heard about it. Actually, this is the most recent, the most exciting development in the artificial intelligence area. I can share one interesting number. So ChatGPT managed to collect 100 million clients in 2 months. The second in the row is TikTok, which took 9 months to get the same number of clients. So this tells something, right? I personally use ChatGPT almost all the days, almost every day. I very much recommend you to do the same. I was curious to check what are the possibilities of ChatGPT already in investing areas. So I asked a question. ChatGPT, can you make me a balanced portfolio of ETFs? And actually it surprised me a lot. It gave me quite nice diversified ETFs, which actually I would take and invest into. So imagine if ChatGPT tool, which under sayings of developers, it will soon be 1,000 times better than the current version. Imagine that it is joined with Bloomberg, Morningstar, Refinitiv, whatever data set. And ChatGPT, artificial intelligence tool, would be able to calculate all the data behind. So I think that it's soon that will be possible. So, and maybe even this year. So such things like, hey Siri, find me the best investment based on my profile and invest 100 euros. And after a couple of seconds, you have the transaction in your app. So I think that's what is coming, and it's coming in a very big and soon steps. The next one is automated investments or robo-advice. So this is not a new topic. This topic has been discussed already for the last 15-20 years. It gains popularity. It started in the United States. The current assets under management of robo-advisory, all the investments, is around 2 trillion, which is a huge number. However, in Europe, it's not so actually popular. As it's only 10% of total global assets under management. We have 200 billion in it. However, as the tool simplicity, the number of market participants is increasing, the competition is increasing, the assets under management is also increasing, and Europe is catching up with the rest of the world. So currently we have more or less 13% growth of assets under management in robo-advice tools. The good thing is that when the number of market participants is increasing, so it's better for retail clients, because retail clients can invest with lower amounts. So as an example, there are robo-advisory fintechs who offer to start investing from €1. Imagine you invest €1 in 1,000 securities, which is very diversified. And specifically, I wanted to show an example in Germany, which looks promising, and they have created ETF savings plans, which is recurring investment. You make a one-time investment and you forget about it. So these small portions every week, every month. The current numbers are that 5 million people in Germany are making these investments, and BlackRock forecasts that after 4 years, this number will increase 4 times to 20 million, which also gives a good proof that this tool might be very interesting, very easy, and very simple to retail investments. The next topic is blockchain. So what's the first word that comes to your mind when you hear about blockchain? I might guess it's cryptocurrency, right? In this case, let's not talk about cryptocurrencies. So in this case, I'm very excited to try to imagine what we can expect from blockchain as a tool. So especially in investment area, such things are already happening. And I'm very excited to see in a couple of years when we will not only create very standalone tools, but we will expand across Europe, across the globe. And examples could be, we have financial markets, which are like for a couple of hundred of years already established, working with many intermediaries between the client and the execution broker, as an example. So imagine client sells his portfolio and gets money the same day. Or you can issue a digital bond and give simple access to retail. So this is possible with blockchain. And actually ESMA currently invites all the fintechs, all the banks to participate in different programs to check and prove how this technology could be used to enable capital markets, enable access to retail investors. So next topic is virtual and augmented reality. This is probably the least progressing part among all the 5 topics. So it will be interesting to see where it goes. This technology could be used, for example, to give more knowledge to retail investors. Imagine you put glasses and you see all the amazing visuals, pictures from which you understand what the stock is, what the bond is, what are the financial markets. So I tried to look into and find some examples of recent, let's say, developments about which would be related to investments, and found one actually nice example. I'm not sure whether it will be popular, whether it will be used, but Fidelity is developing currently a virtual portfolio. So imagine you, again, not very comfortable, right? But maybe at some point of time we'll get used to it. You put on these big glasses and you can find your investment portfolio in virtual reality. So they created a city. Every building is your every possession, every stock. The higher the building, the more you earn. If it is, for example, night, the trading is not working. If it is day, there are market trading hours. If the sun is shining, your portfolio is going up. If the rain is raining, your portfolio is going down. So it's interesting. I would say more like nice to have tools. Maybe not everybody would use them, but yeah, interesting development here. And the last one, which actually summarizes everything. So it's not like something new, but it summarizes the previous 4 developments. So without digital platforms, without mobile applications, I don't see actually that we can reach structural changes in how retail invest. And the numbers says for themselves. So currently we have an amazing number of 86% people in Europe having mobiles. So this means that actually everybody above 14 age have mobile, which says a lot, right? And especially during COVID, the number of people who invest in securities increased a lot. So the number is 5 times. Actually, in 2016, I thought that it is not possible to encourage retail clients to invest via mobile. I thought that the only way is that the client has to come to the branch to meet the person face-to-face to get recommendation, and that's how investments are done. But now I think totally differently. I think that if you don't have a mobile, if you don't have a simple, easy platform which is accessible to everyone, which is scalable, there is no future, basically, for this business for you. Thank you.
Okay. Thank you, Rolandas, for your insights. And it seems like Siri will have to learn something about MiFID. And I wonder how this might happen, but okay, let's continue our discussion. And I would like to start from the again, the topic of retail investors and the demand side. And Vytautas, that will be a question for you, since you are representing the Investors Association. So I think the primary question here is, what are the preferences of retail investors, and what do they need and what they are looking for in order to start investing?
Retail investors need simple access to a variety of products. Okay, now it's better. So retail investors need simple access to a variety of products, and for one investor it's good to have, annual savings plan where you put money into ETFs or simple cheap mutual fund. Another investors would like to buy individual stocks, and that's for every person to decide. And I think two things: if we create simple and easy access, and another part of the puzzle is education, because even if this access is available, people who are not educated usually doing stupid things with their money. Like a couple of years ago, I couldn't exit any conversation where people do not touch, cryptocurrencies, because it's so exciting, and you're saying those are worthless, you will lose your money, better give it to me, I will transfer to charity. So it's financial literacy is as well as the key, because only technology will not help people navigate this difficult financial world and understand those acronyms.
Okay, speaking about products, there is a supply of platforms, apps and products. Why don't people invest still?
Because they don't know what to do. So the choice is enormous. And then how do you choose? So what's best for you? Because if you start even from ETFs, there are thousands of them. So how do you choose the best one? So I have my answer how I do it, but for average person, Vanguard in Lithuania would be not a household name. So how do you find out that this firm exists and offers good products for retail? So platforms exist, and technological innovation made access comparably easy, and there is a wide variety of choice. I understand that the supply will only get better, but if you want to invest successfully, you have to find yourself what to buy, and not to buy products which some intermediaries are selling for their high commissions.
Okay. Rolandas, maybe coming back to you, what is your perspective? How do you develop that habit of investment? And maybe we can learn something from the payments success.
Actually, a good question. Looking back into history, how Revolut started in 2015. So it launched a payments product, which why it was successful. So it at least we state that it's 10 times better than our competitors. UX, user experience and user interface is much better, was not much better at the time, but the most important part was price. So combine these all things, we can think similarly about investments. So make your product 10 times better than competitors, make it cheap, make it free of charge, and that's how you will reach the amount of clients you wish.
Okay, I guess that's what we are looking for. Jeff, not to limit ourselves with the EU, and you are coming from the US, maybe you could share some insights from the US market And also we would be very keen to know what Dry Wealth does and how Dry Wealth could contribute in solving these issues.
Sure. So Drive Wealth, I'll start with what we do. Drive Wealth is a fintech that specializes in providing brokerage infrastructure for partners like Revolut. Revolut's one of our partners. Cash App in the US, Toss in South Korea, and hundreds of others. Our platform provides the trading, execution, and custody services to provide a safe environment with a low-cost barrier of entry for anybody. What this enables people to do is to break down very easily the costs and reduce the cost greatly, so the barrier to entry for anybody. As we know, like many of the large broker-dealers or wirehouses have very high minimums in order to even open an account. This allows you to, with as little as a penny, open an account. We provide what we call fractional securities. So we are able to, if you wanted to buy $1 Berkshire Hathaway A or €1, you could. And that's extremely powerful because people now can create portfolios with just pennies. And that's extremely powerful then to enable people to start shifting from the idea of savings to when I go into a grocery store or a cafe and I buy my coffee, that swipe, that few cents that's left over to round up to the full euro could immediately be invested into a brokerage account and invested for your retirement savings. And as we heard, you know, the commission talk and the ministry talk about, and it's the same in the US, right? The faith that the retirement accounts will be there for our children in the US from Social Security isn't there, right? My kids don't believe they're going to have a Social Security system. They are already investing. And that's the cool power of these technologies. There are actually providers that are connected to us today that are powering accounts for teenagers. Parents have to approve the trading, but the teenager could already start learning and investing and trading. And that's an extremely powerful concept. In the US, right now, our markets are still obviously very strong. If you were to look at the S&P over the last 5 years, it has a 50% return, even in this type of market construct. But I see where the real power is today is that we are seeing large growth in non-US customers coming onto our platform through our partners like Revolut and others. In fact, we almost had a double increase last year on non-US customers. And what you see is the millennials are actually the most actively trading in this past year, even during this down market. They accounted for 46% of the trading in our US securities products.
Okay, one more question to you. Can technology also help with financial literacy?
Yeah, again, I mentioned there's these companies that are catering to helping teens have accounts and do trading. Those same companies are providing vignettes or videos for the kids to take and courses to learn. And once you do a certain number of those courses, you then get open access to stock trading or bond trading, et cetera. And there's all sorts of cool things that we can be doing with that kind of educational material to add to platforms. I know Revolut's looking at stuff like that, and some of our other partners are doing it as well. And I think that will be becoming extremely important. In the US, when I was in high school, I had an economics class. We learned how to balance our checkbook and we learned how to do stuff. My kids don't have that, right? Those courses went away for whatever reason. We need to find ways to teach our kids how to invest and save.
Okay, thank you. Perhaps going one step further and discussing technology and discussing the future, we cannot miss out the digital assets as such. And well, for me, it's a completely other universe. So Jan, I'm turning to you. Maybe I'm not the only one in this room who is not that familiar with decentralized finance. Can you please enlighten us? What is it about and what issues this can help solve and what's trending actually?
Sure. So decentralized finance is actually part of the whole blockchain technology, which is kind of underpinning decentralized finance. Decentralized finance is, if you compare the traditional finance, I would call it traditional finance rather than centralized, because you have some centralized aspects within the decentralized finance vertical as well. It is understand it as a digital marketplace where you can use very similar tools like in traditional finance. You can go and borrow and lend. You can use derivatives. You can trade. It works differently than traditional finance. It's an open, permissionless source. That means that you don't have any bank broker in the middle to supervise. You can open your wallet, which is rather easier than opening a bank account, as we know. It's borderless, so it's not limited to geos or jurisdictions. It's based on the blockchain technology, which is the DLT technology. To understand it, it's capturing transactional, or any transaction will be captured in blocks from day 0 to date. So it's out there, it's public, it's very difficult, it's impossible almost to hamper with those data once they become public. So there's a huge transparency on that part. Not to forget is the last part of those features are the contracts. The automated contracts that are helping actually to execute those transactions on blockchain. So they are again standalone. They are pegged on conditions of certain deals. Once those conditions have been accomplished, they release the funds, they release the money, and etc. And they are relying on oracles, which are kind of piece of intel gathering and feeding kind of information from outside world. So that's a kind of at high level described decentralized finance. In terms of market, in 2021, it was a massive hype. It went up to valuation of 200 billion, but came down very quickly in last year, 2022, through numerous factors in the market. One of the reasons was monetary tightening. So that means, the investors kind of invested less in riskier assets like crypto and digital assets, but also some of the companies imploded or declared bankruptcy. You look at in May last year, it was Luna, which has own ecosystem, and it just collapsed altogether, followed by different companies, different providers, and lately it was the FTX exchange, which was the most trusted almost in the market, so that didn't help either. However, to point out, it is in relation to certain behavior or macroeconomics aspects, etc. But the blockchain technology actually thrived and developed further, and it's becoming more robust. So we witnessed the change on the Ethereum blockchain from proof of work, which is a very not really eco-friendly validation of information on the blockchain, to proof of stake, which is more eco-friendly, not heavily dependent on energy and gas and electricity. So that helps to build on those platforms going now into 2023. And there's a huge interest from institutional investors kind of entering the digital asset space on many fronts. You look at stablecoin settlements, there are projects around the central bank digital currencies, tokenization in capital markets, and the list goes on and on.
Can you give us some concrete examples of the use cases?
On the blockchain, kind of payment blockchain, you have you can do derivatives and borrowing and lending, but also to expand beyond DeFi itself. You can also think about NFTs potentially, where they imploded a little bit as well, but the technology thrive, especially in certain verticals of the space. So we saw huge uplift in film industry and financing of movies, which it function on a basis that any producer producing movies is kind of tasked to go and chase money and talking to VCs and investors, and it's very difficult to do it. The tendency is to turn the table and turn to public and try to participate and help, and you will be rewarded on the success of the actual movie. So that's kind of NFT based. They said NFT airlines ticketing is taking off as well. TravelX is one of the platforms offering that, so pegging lots of airlines to be part of this. And because the move from proof of work to proof of stake, it's actually more sustainable. as well, which is the target for all airlines around the globe. And the actual ticketing, if you go to concerts and you name it, the list is very long. It's just create a kind of the memorable memory. You can't really falsify the ticket. It's stored. It doesn't get damaged, or alternatively, you can hold on to it, and it can be traded in the black markets and so forth. So that's kind of on the blockchain-based NFT examples beyond DeFi.
So would it be correct to say that these kind of use cases is basically showing an alternative to traditional financial instruments as we know them?
They are. The technology is robust. We can see a couple of examples. It was mentioned on the presentation there that mainstream banks are also leveraging the block technology a lot. The last I came to my mind was in November, I think there was the JP Morgan cross-border payments or transaction with DBS and SBI, the Japanese asset manager. So they did live transaction cross-border. They use it for repo on the blockchain. So this happened. It's not exclusive. Both technologies are complementing each other. So there's a space to live together, and I think that's the way it's going to develop in this year anyway. And another use cases are, you have the FX exposure, for instance, on the side of settlements, because they're exposed until they settled and meet the obligation. Again, at the DLT technology, they can do it at the same time without that exposure to run short. You have cross-border payments. You have interesting news actually was around Swift, where they are looking at a pilot with Chainlink, maybe to tap into blockchain and kind of speed up those transaction and messaging around the globe. Look at trade finance, crossed my mind as well. It's a very paper-heavy segment. Imagine you need to deploy different escrows in the middle of it. It's very costly and dealing it, so it could be based on blockchain, and there are companies looking into it as well. And being leveraged on both sides. So a couple of examples. So I think the space to live together, it's here and stays here. Also, the fiat side or the traditional finance could be seen as the gate, the entry to get the funds over to the blockchain or DeFi space. So it can't work without each other, unless we are all paid in crypto. And then we pay in crypto in shops, and you make it as a mass adoption, which I can't see happening in 2023 anyway.
Okay. Any concerns with the digital assets, Vytautas?
They are, yeah.
From the investor's perspective.
So basically, people are saying it's decentralized. It's let's start from QAC. Are we good, with not knowing the identity of our counterparties? We can talk about those algorithms, but I see almost every month somebody hacked your algorithm, stole 200 million. Okay, thank you. Basically, if you don't understand what you are doing, you will lose the money. Majority use cases or problems those people are solving are solvable without blockchain. And for me, the biggest area which might be affected is payments, because it's really either Revolut will dominate the world and then you transfer from one Revolut account to another and that's it. Or there should be solution if you're transferring money from Europe to US, that you don't wait ages for this money to arrive. So for payments, I would see. For securities settlements, why you have to wait this T+2, of course, it can be done and should be done better. But majority of things, simple average person encounters, it's simply transfer of their personal wealth. And I'm saying to my friends that give you give me why you're doing this, or what kind of asset you're buying, what cash flow does it produce, and the answers, Vitas, you told you don't understand anything. It's new reality. So my reality is that those people will lose money, and that's good, actually. You need to pay like some fee for your education.
Okay, anyone else wanted to comment?
I actually can say one fact. I have read, I don't know whether it's true or not, but this blockchain technology, it's calculated that if it is implemented more like widely, so it could save like 20 billion at least per annum for financial sector. So I think it has a huge potential that is definitely will be like in ahead of us.
Okay. I wonder how this may change the infrastructure that we have today, especially in the capital markets, in securities. We have the central securities depository, we have exchanges. So what might be the change here? No, Jan or Jeff?
Yeah, Jeff. It could be, in direction of the tokenization of those assets and then self-custody kind of direction, because I think from the customer perspective, they prefer to have one pool rather than managing the portfolio in segregated pools. So that could be one of those helping aspects as well on that front.
I'd say blockchain is going to be disruptive for the exchanges and for the regulators, right? It's going to create a new paradigm on how do they track and record the transactions. Right now, we're very antiquated infrastructure in the US and in Europe. In fact, our trade volume is so large that our regulators sometimes have trouble ingesting it, right? And so they have to catch up, the regulators have to catch up, and I think blockchain could be that way for them to do that. Also, just on our technology, it's not blockchain, right, currently, but it is disruptive. It's pulling in a tremendous amount of retail investors into the US markets currently. There's opportunities for us to do it with exchanges around the globe. We've been having conversations with exchanges in LATAM and in Europe. Maybe we'll be doing it with the Baltics as well, and been outreach from the Middle East and other exchanges where how we could bring fractional trading to their exchanges to pull in retail investors, pull in more capital financing into their local markets. And this technology can do that. It can really, our whole purpose is to democratize investing. And democratize investing doesn't mean US-centric, it means investing and globally.
Okay. It goes, maybe to add quickly, it goes also for the exchanges themselves, and I'm talking about crypto exchanges, because they need access to local method of payments and APMs, and they are relying on traditional finance to a degree, on acquirers and etc. anyway.
Okay, good. Maybe coming back a little bit to Revolut. So what can we expect as retail investors? What is up and coming?
I can't disclose too much, but yeah, you can expect a lot. So currently we have like really the basics US stocks, right? So as far as you know, like we have like a lot of different financial instruments around, right? So, and the Revolut's target is to become a super app, a super financial app. So you can expect at some point of time to get all the access to all the instruments in the most simple, in the best possible way.
Okay. And do you think investment account is the key here, or you will achieve your goals somehow without that?
You mean in Lithuania?
Yes.
No, it's not the key. It might be important, like there are good examples in Finland, yeah, in Estonia, like in Latvia, not far away. But investment account might help reduce taxes, let's say in this case, but it's not only the let's say the fix for all the issues. So we should start from looking into our products, into our user interfaces, into user experience, into trying to make clients always happy, reducing costs as well as earning money. So these are the success, let's say, keys.
Okay, thank you. Before we go to the final remarks, maybe we have questions from the audience. Yeah, there is one.
Sorry, me again. Terribly sorry. But I'm really, really super curious because I'm not sure everyone in the audience is as tech savvy as the learned panelists. So since the days of the family of Tapscots, we're going around and raising excitement about blockchain technology, telling how it will change all the ways and will increase efficiencies, will cut costs, and importantly, increase safety of financial transactions. So we were getting very excited for 10 years now. So I really would like to hear from the experts now on the stage, what do we learn from the FTX disaster? Is it like technological vulnerability that you could like to comment on? Or is it like human vulnerability that just individual kind of personal problems got in the way of allowing those technologies to really achieve the best it can? Thank you.
So scammers with no police, very simple. Like I'm not regulated. I can take my clients' money and sponsor politicians. You know, so it's a scam, and it's bad for the users because it's not regulated, and you cannot even now the SEC started let's move, but I think the main problem we can take another big exchange like Binance. It's not even disclosing in which country it exists, where it's incorporated. So it's again, this environment is very good for scammers and people who want to take other people's money. And
so I'd say, so I spent 17 years at the regulator in the US, FINRA. I ran the New York office during the financial crisis. I oversaw a team that went into Madoff, was on the calls with Barry Lehman, et cetera. It's scary how similar this situation has been to those situations. And it's made worse by the fact that no regulator really stepped in to really take control of this currency, cryptocurrency or crypto tokens, however you want to call it. I think we're still waiting to find out what the regulatory regime will be in the US, will be here. I do see more movement in Europe than in the US currently. But to answer your question directly, this is mostly an issue about the people and the lack of ethics and lack of governance and control around the product. In the US, we obviously have a large gun issue, and you always hear people say guns don't kill, people kill. Products don't cause the fraud, people cause the fraud. And that's what you saw in this case, right? And I think there's still a lot left to be heard, but it's really less about the crypto product itself and how it's being used, managed, and governed.
Okay, that's exactly my point on this as well. So it's not the actual underpinning technology we're looking at, which is deployed now by mainstream banks like JP Morgan and DBS and Mellon, but it's the behavior that's basically allowed to trade without any repercussions out in the market. It's changing slowly, right? I mean, we might have some registration and regulation in Europe soon, maybe towards the end of the year. That might help. But back to your question, it's really 90% of those behavior, except maybe Luna, which was the algorithmic stablecoin, which was a different issue. It's more related to kind of a human behavior rather than the actual technology of the blockchain.
Well, fraud is fraud. Any other questions from the audience? Sorry, please take the mic.
I have two questions. One is for Rolandus. What is the name of company you mentioned where Germans are investing now? The small amounts.
It's combined. I mean, across the market. Basically, behind are robo-advisors, which are quite popular in Germany. One of the most popular at the moment, of course, I wouldn't maybe want to mention competitors, but in this case, I will make an exception. So it's Scalable Capital is the one leading the space.
And the second question is about robot trading, because in the past there were several accidents in Forex exchange market where robots made mistakes and several brokerage went bankruptcy. So how this problem is solved now, or it's still
I expect again for me, right? So it's a bit different. So one thing is when you create rules that trade on your book, let's say, especially with ethics, where the volumes are much different. And the other thing is when you create some rules that govern or manage client portfolios. And currently there are like many different robo-advice, let's say, different development stages, right? So even 5 different. So the first one is that client comes into the branch, fills in some paper questionnaire, and then behind there is a portfolio manager who buys like manually all these securities to client. This was robo-advice 1.0. If we talk about the latest developments, right, robo-advice like 5.0 or something like that, so the technologies are a bit more advanced. Still, there is no such thing that you create some rules like if this happens, then do like that. So we're not so technologically advanced, I think, still, of course, with the exception of some companies. But behind robo-advice, what from user interface looks beautiful to client, in the back end, still there are like manual operations done, right? Of course, again, with exceptions. So in this case, I would say retail is quite protected as well in Europe by regulations, by MiFID. And there are 2 different maybe definitions here. What's worth to tell, it's algorithmic trading versus robo-advice. And algorithmic trading has different rules, has different regulation, and I think that a lot of companies try to avoid like getting into algorithmic trading regulations.
Any further questions? Yeah, there's one here.
Hi, can you hear me? Just a very short one for Rolandas, and I'm not even sure if you can answer it, but maybe something to keep in mind. I wanted to ask, well, in general, I think it's exciting to know the possibilities that we have that are being unlocked by new digital technologies to improve capital markets and retail investment in general. And it was interesting to hear that you said you have a vision for Revolut of becoming the super app that offers many different possibilities for retail investors. However, here I had 2 thoughts on what your exact vision is. Are you thinking of becoming an app that offers many different investment products, many different, let's say, leverage opportunities, derivatives, and so on to investors, and the business model is going to be about, well, encouraging people to trade more often and generating more fees for the business? Or do you envisage yourself as becoming more of a platform that helps individuals create long-term portfolios that are beneficial to them in the long term?
Actually, it's the same. So the first question is about, in what you mentioned, these 2 things, it's more or less about the same. It's putting like different products for different clients, because there is no one type of investor, right? At least the latest analysis I saw, there are like 5 different types of investors. The majority of them are long-term investors, like a third of them. Others are active traders. So we have different types of investors which need different products, right? And the idea in Revolut is, of course, to be able to offer different product to different client, so that you can find whatever you need.
Okay, maybe one more question. No, perhaps that's it. Okay, so our time is almost up, so we have just a few minutes for the final remarks, and perhaps each of you could share your thoughts on the future and what are your predictions and how we'll see the capital markets different in the upcoming few years, perhaps. I don't know. Rolandas, maybe you want to start.
Yeah, so I'm very exciting about the developments actually myself on artificial intelligence side. So I think that this is the closest one that might have a bigger impact in investing. Remember, like I showed you an example with ChatGPT, what it did. So if the developers of it continue developing it, I think more fintechs would like to integrate this into their solutions. That might help to bring investments into the next level. On top, other products like also will be important and popular as far as they are simple, cheap, and accessible to clients.
Thank you. Jeff?
Yeah, I think the future is very bright. DriveWealth obviously focused our technology first on equities and fractionalizing equities. We are now expanding product set to options, bonds, treasuries, all sorts of other products, including alternatives. I know mentioned before was crowdfunding. We have partners that are working in that space that do some incredible stuff with allowing people to buy artwork or classic cars or baseball cards or anything. And I envision a day when our robo product has an offering that provides a complete set of asset class across all those different types of assets at pennies for a person to start investing for their future in a large way. And it was interesting because one of our colleagues, we've built a team here in Europe. We're very excited to be launching hopefully soon here in Lithuania. Our colleague from Ireland was in, he was saying how the classic cars in Ireland are exempt from tax on inheritance tax. Well, you know, if you could have a robo that helps you invest portion of your securities or your investments into that asset class, that would be very advantageous if you're in Ireland, right? And so the robo products, I think, are going to start getting more advanced to help people with their tax situation and their retirement planning and so forth. And we're happy to be on the forefront to work with partners like Revolut and others around the world. So it's exciting.
Thank you. Vytautas, anything positive, optimistic, please?
Actually, I'm a very positive person, so number of investors will definitely grow with each year, and on the supply side there will be more supply of different products, and for the whole industry the key is to educate their client, because if the pie will be bigger, everybody will benefit. Of course, we are from the small region, and you know, sometimes those globalization terms, it's for the retail client, maybe it's easiest to buy very simple MSCI World ETF and forget about it. So here at the local market, we just have to be better.
Thank you. Jan.
From my end, you know, as I can see that lots of investors are getting more familiar with the blockchain, so I can see more driving on that from mainstream banks kind of entering this space directly or through different acquisitions in the market, expanding on the capital markets, especially around the tokenizations. There's a huge potential around those NFTs where you can store so much value, and we are at the infancy stage with this whole project. You have lots of promising projects in terms of central bank digital currencies. China is coming out now after kind of those restrictions, COVID related. So interesting to see what's happened there. You have India, Nigeria, kind of we have 11 countries running it. Lots of countries are thinking about it and then investigating and assessing. So I can see that's the direction in this year actually will pick up.
Okay. Thank you, everyone. I think that concludes our discussion and concludes our panel. Well, I'm personally very happy to see the companies that were present here and that they are present actually in Lithuania. And with that, I think that we will have a very, very interesting and bright future ahead. So thank you, everyone, for contributing to this discussion, and thank you very much for the audience.
Thank you so much to all the panelists. Just to reiterate some of the thoughts, artificial intelligence, lots of hope here. More fintech will integrate it into their solutions. Robo-advisors, blockchain, virtual and augmented reality, digital platforms and mobile apps. The future is very bright, as has been said by a couple of panelists. More investors are becoming familiar with blockchain. The number of investors will grow each year. From the point of view of investors, platforms exist, access is made easy, supply will only get better, but you have to find products that suit you, or as Vytautas put it, which intermediaries are not selling with higher commission, and you have to not be too old to have a better understanding of a new reality, as he put it. So that was my takeaway. Everyone is free to collect theirs. If you have done so, do save them for the reception, which is happening in a minute. Discuss it with your colleagues over a glass of wine. And on behalf of the organizers of the conference, the Ministry of Finance of the Republic of Lithuania, as well as the Lithuanian Banking Association, I would like to thank all of the speakers, all of the moderators, all of the panelists, and all of you for being here, for asking your questions, for being so interactive, for listening. Thank you so very much for making this day so fruitful, informative, and memorable. And I wish you a pleasant event and a wonderful weekend ahead. Thank you so much.